We've had a really good run in asset prices here.
With another round of tariffs coming and the blizzard of policies that come out of Washington, there's going to be a lot of volatility.
The key downside risk from our perspective would be if the tariffs wind up amounting to more than we had anticipated.
I think people pull out, the valuation questions are there, and we have this erratic policy that's too hard to invest.
We're probably going to get some pullbacks, high valuation, slower growth, policy uncertainty.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
This is the longest trading week ever. Live from New York City this morning. Good morning for our audience worldwide. Bloomberg Surveillance starts right now. Coming into Thursday with equity futures resuming the decline after snapping a two-day losing streak yesterday briefly. On the S&P 500, we're negative by 1.2%. On the Nasdaq 100, we're down by 1.4%. Your day ahead looks like this. 8:30 Eastern Time. Jobless claims just around the corner. 8:15, a very interesting ECB meeting with the German debt market taking centre stage. 10-year yields in Germany just having their worst day since 1990. We started the week at 240, and right now we're pushing 280.
Which really raises the question, just how much can this bond market absorb the bazooka that Germany may or may not be unleashing? You cannot overstate, or I should say, you cannot understate how much we have seen a traumatic change to the bond market globally, because it's not just Europe. You're seeing it in Japan, you're seeing it in Australia, and it raises the question, if we get mass fiscal spending from the likes of Europe, can this bond market absorb it at a time where we're already dealing with inflation and we already have a lot of debt sloshing out there?
Biggest move in some 30 years in the German debt market. You mentioned Japan. German 10-year yields are pushing higher. Japanese 10-year, 30-year yields, levels we haven't seen since 08-09. We still need to talk about trade policy as well. An exemption for the autos for a month. The confusion just reigns stateside on policy.
Tariff uncertainty, another day of it, continues. We do know that autos, according to this White House, are going to get that 1 month exemption. This comes after Howard Lutnick, the Commerce Secretary, said to us, well, yeah, according to my understanding, they are USMCA compliant. So that begs the question, what other companies are calling the Oval Office saying, I'm also USMCA compliant? We know that, according to our colleagues down in Washington, maybe agricultural companies will get some sort of exemption. But this is why it is so confusing who potentially is in and who's going to be out.
How companies respond to this as well is going to be increasingly interesting. We heard from Best Buy and Target, who said they would be passing on the tariffs to consumers. Walmart, based on our reporting here at Bloomberg, taking a very, very different approach to this. And I'm going to share this story with you now. Some suppliers, including producers of kitchenware and clothing, have been asked to lower their prices by as much as 10% per round of tariffs, according to our reporting, essentially shouldering the full cost of the new tariffs.
And these are producers in China in particular. And this raises a question about their profit margins, maybe none, maybe even taking losses, and how much these producers in China can jawbone their supply chains lower themselves and get costs lower. Again, this highlights two things. Number one, who's going to bear the brunt of this? And number two, can U.S. consumers, with a diminishing consumer appetite, handle higher prices? And what are companies going to do to avoid doing that? Because, frankly, the demand just isn't there.
And this is why we've got to all be really open-minded about how the costs will be distributed if the tariffs do stick. There is plenty of different things that can happen here. The exporter can eat it. The importer can eat it. They can pass it on to the consumer. It can be a combination of all three. And the FX channel is important as well. Developments in foreign exchange have gone against what maybe a lot of people thought would happen. Tariffs went on, the dollar's weaker. The dollar's weaker again in the last 24 hours. Coming up on this program, we'll catch up with Jim Bianco of Bianco Research as the global bond sell-off continues. Terry Haines of Pangaea Policy as Trump offers autos some relief. And Jane Foley of Rabobank on the end of dollar dominance. We begin this hour with the global bond market sell-off gaining steam. EU leaders holding an emergency defence summit as Germany gears up to ramp up spending. Bloomberg's Ollie Crook joins us now from Brussels. Ollie, typically it would be ECB day. I'm not sure how many people care about this ECB. Front and centre in the driving seat is Brussels and where you are.
That's right, Jonathan. You can see just behind me, I think we have Zelensky just arriving along with the European leaders, having this emergency meeting that was called just some weeks ago after a number of sort of policy initiatives by Donald Trump and really the reality of what this presidency means for Europe and European security. Jonathan, we've talked about it many, many times. We've had leaders, politicians, everyone tell us it's been a wake-up call since November. This is the week that Europe got out of bed. We saw it at the EU level where we was talking about releasing up to 800 billion euros worth of spending in terms of different initiatives, 150 billion euros in terms of loans. But really the main issue here, Jonathan, and you'll know this from covering the crisis, we have a chancellor coming into Germany, a CDU leader. This is the party that put the debt brake into the constitution of Germany, who is now lobbying to make exceptions so that the EU will loosen its fiscal rules so that EU countries can get more debt. That comes after, bazookas of their own fiscal plans of 5, 6, 700 billion euros in terms of spending on infrastructure and defense. This is exactly the point, Jonathan. We talk about the market impact, generally speaking, on this kind of day is monetary policy. Right now, it is fiscal policy, and it's moving the bond market in ways that, frankly, Lagarde and the ECB never could.
And Oliver, that incoming chancellor, really taking a phrase, a playbook from a former ECB official, an Italian, Mario Draghi, when he says whatever it takes when it comes to defense. What are they hoping to get out of this emergency summit?
So listen, they're going to ratify a number of the proposals that have been put out in terms of these sort of outlined by Ursula von der Leyen earlier in the week. Again, this is going to look at easing fiscal rules. This is going to look at sort of direct lending. But for me, in terms of what I'm watching very, very closely is how active is the discussion right now among these EU leaders about the question of joint debt. I mean, I think it's going to be an inevitable conversation. It may be a little bit too early in the game. We have another EU leader meeting in a couple of weeks' time. Maybe it comes up there. But this is going to have to be one of the other active conversations, and especially in the light of the last week, what we saw from Donald Trump stopping weapons supply to Ukraine, basically withholding intelligence. We're also going to get this conversation potentially on those Russian assets, those $300 billion worth of frozen Russian assets. How much appetite is there at the leader level to start to tap these, to start to basically deal with a lot of these unprecedented moments here for Europe? I think that the one thing that we started to see this week, again, in all of the talk, all of the rhetoric we've heard for the last 3 months, is that some of these European leaders are now ready to think outside of the box and make some sort of policy proposals that they've just been too shy, too reticent to do in the last sort of weeks and months.
Ollie, can we just finish up on this? These are things that some European nations, particularly in the south of the continent, have been asking for ages. If they look at the policy track record of their German neighbours, German foreign policy has failed, economic policy has failed, energy policy has failed. And only now, led by Germany, is there at least a consideration of ripping up the fiscal rules on the continent. How does the rest of Europe feel about still being led by German policy with such an awful track record?
Well, listen, I think that unfortunately, there's an inevitability to it, right? It's like that bazooka came out in Germany, and that is basically what shifted anything. I mean, I think there was going to be some resentment. And frankly, I mean, again, we've talked about it for many, many months. We've pressed a lot of leaders on many of these issues. Guys, is it time to start talking about these things, moving outside of the box? And there's been basically a resistance to do it. But Jonathan, there's another dimension to this as well. They're trying to push through this debt brake reform with the last parliament, where they have the 2/3 majority in order to move the debt brake. You have a new parliament coming in Germany. The AfD, the far right, has won 1/5 of the seats there. They're doing it now because they wouldn't be able to do it later. This is another sort of internal domestic national issue that you're going to have in Germany, and you're going to have some resistance also in some other parts of Europe. You have Viktor Orban, who's going to move to block some of these things. So I don't think it's as clean a shot as the Europeans would like it to be. This is going to be igniting a lot of sort of debate, not just at the leader level, but nationally for a number of these leaders.
Ollie Crook, appreciate it. Over in Brussels, it is ECB day. I will say that news conference with President Lagarde gets a whole lot more interesting. How does she feel about what's taking place at a fiscal level, potentially, and what will it mean for this debt market? Joining us now is Jim Bianco of Bianco Research. Jim, welcome to the programme, sir. Do we need to rip up the global playbook for investing now?
Oh, I think it's already been ripped up, and it's been ripped up largely because of what's been happening with this payment for security coming out of Europe. As you mentioned before with Ollie Crook, they're going to tear up their debt brake. They're going to deficit spend. They're going to spend money like crazy. You can see it with the way that their yields are soaring higher, their stock markets are soaring higher. Even if you look at their real rate bonds that would anticipate inflation, they're going vertical right now, that a big inflation is coming. And just to kind of lead you a little bit, we've got the ECB meeting in an hour and a half that they're so trapped with forward guidance. It looks like they're going to cut rates right into the teeth of a market that looks like we're going to have the economy soaring and inflation going straight up, and it's going to look like it's a gigantic mistake even before they even make the move.
Jim, it's early days, and you're right that it is consensus that the ECB will cut by 25 basis points. But Ollie Crook there made a great point, which is right now what's going on doesn't have a lot to do with Fed or ECB policy. This has to do with fiscal, and fiscal is very much in the driving seat. And I wonder whether it really just permanently shifts higher yields, not just in Europe, but globally, including the United States, going into the future if, and it's a big if, some of these plans do go through.
Yeah, if we assume these plans go through, you're going to see much higher rates in Europe. You're also going to see higher stock markets, too. You're going to see higher rates around the world. Japan looks like it's finally recovering. It's got a higher inflation rate than the U.S. Their rates went over 1.5% for the first time since 2009. So rates around the world are going higher. In the U.S., we have an inflation problem. We had a monster inflation number in January. We have a trending higher inflation. The prices paid index for both ISM services and manufacturing was above 62 for the first time in 3 years, which is when we had a big inflation problem. And if you took University of Michigan, looking at the highest numbers in 30 years on expected inflation, our interest rates should be going straight up too. Why aren't they? Because we're stuck in the mud thinking that this tariff thing is going to cause a recession. But if we ever get off of that idea, there won't be a recession because of tariffs. We could see a massive snapback in yields here following the rest of the world higher, and maybe even substantially higher, back to like the 480 level, or not higher, even higher than that. 480 is where we were in January.
Some people would argue that the reason why people are looking at lower yields and more disinflation is because we're hearing from companies themselves highlighting how they cannot pass along higher costs. And what you get is maybe a price adjustment, but after that, you get slower growth, you get slower sales. And you're seeing that in terms of corporate messaging pretty much across the board. Why do you reject that? And you think that inflation is going to be the sticky aspect of this that will remain?
If you look at the way that we've been talking about tariffs in the last several months, we're not sure exactly what we're supposed to do with them. And I'd like to joke, I'm old enough to remember January when tariffs were inflationary. Now in March, tariffs are recessionary. What are tariffs going to mean in April? Are they going to be stagflation? We're going to go back to inflation. We're not exactly sure which way they're going to go. I get the uncertainty, and I get that it is driving everybody. We're not exactly sure what their impact on the economy is because we're not exactly sure how long they're going to last. We're worried about tariffs now. Donald Trump hasn't woken up, and we'll see by 4 p.m. when the stock market closes if we have the same view as tariffs as we do right now. And so these things are going to constantly change, and we don't know how long they're going to last. But if they don't could produce that kind of drag on the economy, we're back to fiscal stimulus around the world, big inflation numbers here. And that would be a cocktail for higher interest rates had we not been worried about this recessionary call with tariffs.
Well, Jim, from the market's perspective, it's quite challenging when it comes to the tariffs because they're not even sure which ones are going to stick. And April 2nd, they're not even sure which ones may be introduced. The president said at his joint address to Congress, this will be disruptive. And then the next day, Howard Lutnick came on this program and said, we're going to meet in the middle and potentially there's going to be some reprieve. How much pain do you think this administration is willing to take?
I think that they're probably willing to take a little more pain than everybody thinks. That's why their focus is the 10-year yield. Scott Bessent said, look, you guys in the stock market, you had 220% years back to back, and now you're unchanged after 3 months. Don't come crying to me about that just yet, at least. And if these tariffs cause the pain that we think they're going to cause, they're also going to cause pain in Europe, in Canada, in Mexico, and in China as well, too. And we'll start seeing it in their markets. Right now, their markets almost seem to be ignoring tariffs, like we were talking about earlier. In Europe, they're so talking about the fiscal situation, they haven't noticed tariffs. Here, we talk about tariffs so much, we haven't noticed their fiscal situation. So eventually, I think these stories are going to start to bleed over across one another, and then we'll probably see an agreement on tariffs.
Hey, Jim, appreciate your time. What a market. Jim Bianco there of Bianco Research on the global economy and financial markets as well. I have never seen sentiment shift this quickly across several dimensions, across so many issues in such a small amount of time.
I've never seen such seismic shift from, of all governments, the Germans come out and abandon their debt brake and take a completely fundamental different approach. Donald Trump wanted to shake things up. He's doing it. Now the question is it going to be a case of be careful what you wish for, or is it going to be a case of just wait and see? There will be gains down the road.
Bond yields up, equities down. We're lower by 1.2% on S&P 500 futures. With an update on stories elsewhere, with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. Alibaba shares are rallying in the pre-market for the ADRs, up 2.8%. It unveiled an AI model to rival DeepSeek. It said that it's a big leap over prior versions and uses only a fraction of the data used by DeepSeek's R1. Alibaba has pledged to invest more than $52 billion on AI infrastructure over the next 3 years. Seven & I Holdings plans to IPO 7-Eleven in North America by the second half of 2026. It will also sell its underperforming retail business, replace its CEO, and buy back shares to strengthen the case against the takeover proposal from the Canadian owner of Circle K stores. Seven & I said that it's still constructively engaging with Couche-Tard on its buyout. The U.S. Commerce Department is expected to tap former Morgan Stanley banker Michael Grimes to lead its planned sovereign wealth fund. The fund is part of a larger public-private collaboration to open up large-scale institutional investment options. It is still in its early stages, but is expected to focus on areas of national security. And that's your brief. John.
Danny, thank you. Appreciate it. More from Danny in about 30 minutes' time. Up next on the program, the automakers get a delay.
We spoke with the big three auto dealers. We are going to give a 1-month exemption on any autos coming through USMCA.
Terry Haines of Pangaea Policy joins us next, live from New York City this morning. Good morning. Welcome to the program. Yesterday, snapping a 2-day decline on the S&P 500. Equity futures here negative by a little more than 1 full percentage point. The declines resume. The losses add up. In the bond market, yields higher by 2 basis points, 430. Very briefly on euro dollar through 108, 107.94. That euro has been stronger every single day this week. Under surveillance this morning, the automakers get a delay.
We spoke with the big three auto dealers. We are going to give a 1-month exemption on any autos coming through USMCA. Reciprocal tariffs will still go into effect on April 2nd, but at the request of the companies associated with USMCA, the president is giving them an exemption for 1 month so they are not at an economic disadvantage.
So here's the latest. Let's address the confusion. The White House confirming automakers will get a 1-month exemption from newly imposed tariffs on Mexico and Canada. Press Secretary Caroline Leavitt also leaving the door open to additional carve-outs. Bloomberg's Tyler Kendall joins us now from Washington for more. So, Tyler, are the auto tariffs on or off?
Well, as of now, it looks like they're going to get this 1-month reprieve. But of course, we're going to be looking forward if there's any other companies that perhaps could get an exemption. And we're starting to get some clues here as to how that could develop. Bloomberg News reporting that tech leaders are expected at the White House on Monday. That could include companies like Intel, Qualcomm, as well as IBM. So perhaps chip makers could be in the mix here. And then the U.S. Agriculture Secretary telling Bloomberg News yesterday that the White House is seriously looking at agricultural products when it comes to potential carve-outs or exemptions. She floated fertilizer as one example, which would, of course, have downstream impacts considering the wide use of fertilizer in a bunch of different crop commodities. And then the White House press secretary, Caroline Leavitt, also being asked about whether eggs might be included here, particularly as they become sort of emblematic of high prices in the U.S. And she left the door open, saying that President Trump wants to hear from industries and their leaders. I want to stick on agriculture just for a beat because that is going to keep coming up in our conversations because it often makes congressional Republicans the most queasy. The U.S. agriculture sector lost $26 billion between 2018 and 2019. Of course, that was during the tariffs under the first Trump administration. And I reached out to one Republican who's been kind of in the middle of all of this. That's Senator Ted Cruz, because he is the head of the U.S. Commerce Committee. He also represents Texas, which does so much trade with Mexico. He told me that he hopes that these tariffs are, quote, short-lived, but accomplish President Trump's policy priorities. But the issue with that, John, is that this administration keeps pitching us forward that more tariffs are to come, telling us to stay tuned for that April 2nd date when we're expecting a host of other levies to go into effect.
Tyler, appreciate the update. Tyler Kendall in Washington, D.C. To extend the conversation, Terry Haines of Pangaea Policy joins us now for more. Terry, a number of months ago, before Commerce Secretary Howard Lutnick became the Commerce Secretary, sat around this table and we asked him about carve-outs. He said there won't be any. Terry, what's the approach to carve-outs now?
I think the approach to carve-outs now, John, is kind of typical of the general Trump line. You go in hard, you go in clean on your policy, and then you carve out as needed. That's what we're seeing with autos. That's very likely what we're going to see with tech next week.
Terry, If autos are getting a carve out because they're USMCA compliant, how many companies are we talking about that are USMCA compliant? They're going to be calling the Oval Office saying, don't I get a carve out too?
Potentially hundreds, thousands, sure. And
do they get the carve out?
Well, that's the problem with the approach. Some do, some don't. There's no easy way to tell here. The one of the pitfalls in this approach is that right at the beginning of an administration, you're in a situation where you don't have enough support, whether from a cabinet secretary or since the whole team isn't filled out, or from senior aides who know the inside and outside and can actually vet these policies before the decisions are made. So yeah. That alone enhances confusion in the markets.
How political is this going to get, especially with Republican red states like Iowa, Wisconsin, Ohio, that are massive corn and ag producers?
Oh, it's already getting very political, and I imagine that it will continue. You got a situation where there's broad support for the president's general policy, but there's also broad concern about the specifics of the policy and how well it's thought through. Congress increasingly is going to see its job as providing a counterweight to what it sees as deficiencies in the rollout of the specific policies.
March is drug war month, and that is what we learned yesterday, that this is what the goal is of a lot of the tariff policies. And on April 2nd, we'll get the cohesive grand vision of exactly what kind of rejiggering of the global trade sphere Donald Trump has in mind. Do you already have a sense of how that adds up, whether that means which tariffs stick and how that really handles the drug issue with Canada and Mexico?
I think it's useful, I think, to think about tariffs in two different ways. You've got in Canada and Mexico, one example, and then the April 2nd reciprocal is the other example. The specific tariffs are much more what I call geopolitical in nature. The Canada and Mexico is all about border, is all about drugs, fentanyl, and the like, and Canada and Mexico consider them that way, talk about them with the United States that way. The reciprocal tariffs are much more designed kind of in a pure trade sense and are designed to say, okay, kind of tit for tat trade, but the ultimate goal of those tariffs, frankly, is to lessen tariffs overall. One phrase that Scott Bessent uses, I think, is closely borne in mind, which is that he talks about these things as being data dependent. In other words, what the other countries do in response to our desire to raise to their levels is up to them. Implication being if what they want to do is drop their tariffs or get rid of them entirely, we're for that and we'll do the same thing.
Okay, hold on a second, Terry, because this is what people have been saying. And frankly, yesterday, what we heard from the Commerce Secretary was that essentially there will be tariffs and they will be 25%. Meeting in the middle just means carve outs. And meanwhile, there was a story in the Wall Street Journal saying that when the leaders of Mexico and Canada tried to call Donald Trump ahead of this deadline, he didn't take their calls. What do we make of that?
I make of that as a negotiating tactic. They clearly want some more things and want some more assurances and want some more negotiations to try to get them.
Terry Haines of Pangaea Policy. Terry, appreciate the update. We understand there will be a call with the Mexican leader later on today, I believe. We've got to track the economic data. So the sentiment surveys had been softer. Consumer confidence, softer. ISM manufacturing, weaker. Within that survey, the survey respondents pointed to the tariffs. How much weight you put on that? I don't know. Then we had ISM services. That didn't confirm the slowdown. I think we can take some confidence from that, maybe. We get more data later this morning.
The fascinating thing, though, is that people rejected the strength in the ISM services. It came in above all expectations. The employment component came in stronger than people expected. And yet it didn't materially move the market or shake it from its belief that this was somehow going to be a significant slowdown that was more market than before. That, I think, is interesting in terms of where it puts the emphasis on incoming data.
Going into payrolls tomorrow. Payrolls at 8:30 tomorrow morning. Jobless claims a little bit later as well. Coming up on the programme, we'll talk about the economic data. We'll catch up with Marc Giannoni of Barclays on the US economy with more labour market data still ahead. Equity futures on the S&P near session lows. We're down by more than 1 full percentage point. In the bond market, yields bleed just a little bit higher, up 2 basis points, approaching 430 on 10s, on 30s, approaching 460. From New York City, this is Bloomberg. Live from New York City, welcome to the program. Equity softer this morning. We've got declines. Take a look at the board. We're down by more than 1% on the S&P 500. On the Nasdaq 100, we are lower by 1.3. We're also softer by 1 full percentage point on the Russell. In the bond market, 2-year, 10-year, 30-year, your 10-year yield around 4.30. Yields higher in the last 24 hours, pushed higher by what's developing over in Germany. We'll talk about that in just a second. But also the economic data. ISM services coming in better than expected, going against the grain because the recent data has not been great over the past week on the survey side of things.
Particularly with the ISM manufacturing, where the employment component came in really weak. You've seen this across the board. However, small inflection point, the Bloomberg Economic Surprise Index has just started to creep upward, and we did see that ISM services component, especially the employment one, come in a lot stronger.
We'll get more economic data later this morning, so look out for that. Let's turn to the European board. What a run for the euro. Euro dollar has just had a 3-day run, delivering 4 percentage points of euro strength. That is the best 3-day run in a decade. It's been that good for the euro. We're back to about 108. In the bond market, yields higher on a German 10-year yield. Now, if you're not familiar with the movement in the German debt market, 10 basis point moves are rare. 20 basis point moves are kind of unheard of. 30 basis point moves on German 10-year yields are things we haven't seen since the 1990s. Just unbelievable.
This is the immediate aftermath of the German reunification plan in 1990. That is the last time we saw a move like this. And potentially what they have proposed is as significant as that moment, given the fact that they are potentially going to unleash almost €1 trillion of spending, although potentially that much more because there is a blank check behind defense spending.
I think it's fair to say that it's the biggest move on record for Germany in its current form. On our radar this morning, EU leaders holding an emergency defence summit, the European Union looking to unlock an €800 billion package. The EU Commission President Ursula von der Leyen saying, quote, "We are in an era of rearmament."
I wonder if it's a bit of be careful what you wish for. And we were talking about this yesterday because we were speaking with Bob Michael of JP Morgan Asset Management, who said this week was the peak in dollar exceptionalism. And you wonder if that's going to come on the heels of money being sucked away from the United States in various forms and put toward a renewed dynamism of fiscal spending in Europe. And that, I think, is notable. And it is not just Europe. It is also China. But Europe was being pushed into it by the policies of Donald Trump.
Even though for decades we have seen the U.S. administration, not just Donald Trump, but Biden and others, tell Europe, you need to spend more. I love this quote from the Polish Prime Minister Donald Tusk as he enters into the emergency summit. The situation is very complicated and difficult, but I am convinced that this is the turning point where Europe understood what responsibility rests on it. Is this really the turning point that Europe actually follows through with all the rhetoric?
Euro dollar 107.89. Plenty of coverage on this story throughout this morning. Need to talk about the trade story as well. The Canadian Prime Minister Justin Trudeau isn't open to lifting Canada's retaliatory tariffs unless all US tariffs are also lifted. The Mexican President, Claudia Sheinbaum, saying she will likely have a phone call with President Trump later on today.
So I think that phone call is going to be this morning because every single day she has a press conference in the morning, and she didn't give a reason why, but she said that's actually going to happen later in the afternoon. So likely that'll happen this morning. There's a lot of questions swirling around on what these auto exemptions actually mean, because until Donald Trump and the Oval Office sign a new order, technically, the tariffs are on the auto space right now. Secondary question, the suppliers to the auto sector, are those also going to be exempted? And then what else is left? Brooke Rollins talking to our colleagues Jenny Leonard and Skylar Woodhouse yesterday saying she's hoping the president looks at the agricultural sector. Potentially they'll get a carve out as well.
What do tariffs on avocados and mufflers have to do with potentially reducing the fentanyl trade in North America? And that, I think, is a question that's important to ask. Are there certain steps that Mexico and Canada can take to potentially push away tariffs on avocados and on mufflers? And the fact that the Wall Street Journal is reporting that calls were made and not accepted, and that also people familiar with the matter were talking about the potential that President Trump wants to tell the rest of the world, I am tough, I am going to put these on, raises some real confusion about what's on, what's off, and what the purpose is.
Can they provide the metrics for the Canadians and the Mexicans? We'll see. We need to debate the fallout. We've talked about this a million times. China and the tariffs on Chinese imports are on. That's really important to recognise. So the economic debate sounds a little bit like this. By definition, the importer has to pay the tariff. We've got all that. How the cost is distributed is basically up for debate. Secretary Bessel is making the argument the exporters will eat it. A lot of people are worried that either companies have to take it on the margin, and maybe that leads to job layoffs, or they pass it on to the consumer, and perhaps that leads to inflation. I think we can have an open debate about all of this. Maybe it's a combination of all three. Walmart is doing this, though. It's asking some Chinese suppliers for major price reductions as it looks to shift the burden of tariff impacts. Sources telling us here at Bloomberg that some suppliers have been asked to cut prices by as much as 10%. This is where Secretary Bessel's pushing, and he hopes we'll see much more of this kind of stuff.
And Walmart's the poster child. It's big enough to have the heft to really push these type of changes on the supply chain. Whether the supply chain can handle it is one thing in terms of not becoming profitable and then pushing some of those cost reductions down the chain in other places. There's another point, though, too. And this indicates to me that Walmart doesn't think that it can keep the sales that it has while passing it along to the consumer. And that, I think, speaks to something about the economic data that we've been seeing and some of the uncertainty in some of the data that's been coming out of the United States.
And we're still potentially waiting for what this turns into in terms of retaliatory measures. We do know that China is fighting back, but this morning from the Chinese Commerce Minister, if the U.S. goes further on the wrong path, China will fight until the end. How difficult is this trade war going to be, and the whiplash of these headlines? We're, 6-7 weeks into Trump 2.0?
Some fiery rhetoric on both sides. Let's turn to the US economic data. We get another round of jobless claims at 8:30 Eastern Time, ahead of payrolls tomorrow morning. Marc Giannoni of Barclays writing, we retain our assumption that the FOMC will keep rates unchanged through June, at which point weaker payroll gains and progress on inflation prints should allow it to cut. Marc joins us now for more. Marc, good morning to you.
Good morning.
Let's start with those weaker payrolls gains. What's going to be driving that?
Well, you know, you talked about the trade policy uncertainty that's out there, and I think this is a major factor here in keeping businesses on the side, having them wait or extend a little bit the time until they make a decision on investment. It makes them delay also potential hires. So we think we'll see more of that over the next few months.
Secretary Lutnick came on this program and at the end of the conversation was pretty aggressive about it. He said, this is not my president's data. This is Biden data. It's too soon to see the policy changes that we're doing, the policy push that we're making, show up in the data. Are you seeing it in the data already?
Yeah, I think we've seen in the ISM survey, we've seen some concerns about tariffs. We've seen that in the University of Michigan consumer expectations, consumer sentiment. We've seen that in other measures from the conference board, for instance. So plenty of indications out there among consumers, among businesses as well, that people are concerned about tariffs. They're confused about tariffs. They don't know what the effect is going to be on their activity or on their consumption, on their income.
We've seen this before, though, when the soft data has shown some ambivalence by consumers or even negativity, and then they go out and they spend and they go out to eat. And we saw that yesterday in some of the services spending and the employment. It didn't seem to confirm the negative bias that we're seeing in surveys. When do we know that it actually is bleeding in? And what does the data, Biden data, become Trump data?
Well, I think we'll have plenty of Trump data in coming months. What we have seen now is consumer spending already slow quite a bit in January from the very strong readings that we had in November and December. That's probably going to continue to remain fairly muted in coming months. And the reason for that, I think, is we expect to see lower growth in general due to the trade policy uncertainty, due to concern about income growth for at least some of the consumers. And so with that, we'll see less hiring, so payroll gains should be diminishing. And this is coming both from the trade policy uncertainty, but also on the supply side from fewer workers coming in and entering the labor force and generating jobs and generating income that fuels the consumption. So I think we'll see this deceleration taking place in the first half of this year and continue in the second half of this year. So that should ultimately result in lower growth. So we downgraded our growth projections quite a bit. From something close to 2.5% last year to now our expectation is for this year to have a growth around 1.5%.
This raises a question about the bias in markets right now. Some people have come on this show and said the recessionistas are coming out and saying now is our moment to call recession and be really bearish. And they're wrong. This is just a natural cooling. And that's what we're seeing in the data. And it was the progress that we had seen really heading into this year. When is it something different, or is that accurate?
So we still think that we are not going to go through a recession, or at least that's our baseline case, unless the tariffs continue to increase at levels that we are not anticipating at this point, right? So for the current type of tariffs that are being discussed, we think that we can go through with like slower growth this year, higher inflation. When is this going to change? I think it's when we see even more uncertainty about tariffs, sharper increases in tariffs, and therefore then companies starting lay off workers. We see the unemployment rate tick up, and then the recessionary dynamics would kick in with consumers retrenching, businesses stopping hiring, and then you have these typical recessionary dynamics that would jump in with elevated unemployment rate.
The Fed Beige Book yesterday, tariffs came up 49 times, and this line stuck out to me. Firms in multiple districts noted difficulty passing input costs onto customers. Do you think this is going to force the Fed to move up their cuts?
So we don't think so at this point. Assuming, again, that the tariffs are going to stabilize at the levels that we have seen so far. So we actually, in our baseline, anticipate that the tariffs on Mexico and Canada are going to have significant carve-outs or are going to be removed altogether. That's our baseline assumption. This, I must say, I don't have too much conviction about that, depending on the headlines I hear. So every now and then we hear concerning signs that actually some of the tariffs might stick, in coming months. But assuming that the tariffs on Canada and Mexico have very significant carve-outs, I think we are going to see some moderate slowing. I think it's to 1.5% growth. This is our assumption. If the tariffs stay, we'll have much more significant inflation and we'll have much more significant downturn.
The problem we have to confront in between, though, is the fact that no one knows what the tariffs will be or how widespread the carve-outs will be. And in the meantime, no one can plan. So I keep going back to that phrase we've heard a million times by the business community. They've expressed this so many times in so many different ways. Wait and see. If you wait and see, you're not hiring, you're not investing, you're not doing those things that you came into 2025 thinking about doing. And I think that's a problem. That's the problem we have already. Sitting here and saying that maybe down the road there'll be carve-outs. Perhaps it won't be 25% or it'll be 10. Okay, have that debate. I think it's an important one. But in the near term, we have a problem to confront right now. And that's the idea that people aren't doing things they were otherwise going to do. And that's going to sharpen the economic data potentially.
And it's something that we've talked about extensively, the idea that being on hold, and you said this yesterday, is doing something. It is an inaction. It is a decision. I will also say there are anecdotes, particularly smaller businesses that have much smaller margins and depend on cash flow, that actually are laying people off because, frankly, they can't survive at the same size if they have that kind of tariff pressure on them. And we are hearing that across the board. That we heard that from one of our guests recently.
I think you can have some sympathy in the idea that if you pull back the government's role in the economy and increase the role of the private sector, you can increase the dynamism of the American economy over time. But you have to accept in between, there's a price to pay. If you're a federal worker right now, personally, I wouldn't be booking that vacation. I wouldn't be spending the money on that big ticket item because I'd be worried about whether I have my job or not by the end of the year. Now, you might make the argument that perhaps they're facing forces that all of us in the private sector have been facing for a long, long time, and you'd be right. But ultimately, for the economic data, that conversation's irrelevant. In the meantime, there will be a whole host of people in this economy pulling back because they don't know what the future holds.
And also, it's not just people who work in the federal government, and this is the key. It's contractors with the government. And there was an anecdote that I read this morning in a newspaper about this small company in New York that imports mangoes and avocados from Mexico that are going to be shutting down in certain capacities. There are those anecdotes starting to come out.
The destination still might be good, but
Correct.
The journey could be choppy. Marc, it's good to see you, as always. Thank you, sir. Marc Giannoni there of Barclays. Equity futures right now near session lows. We're down about 1% on the S&P 500. With an update on stories elsewhere, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The Trump administration's top hostage negotiator has met with Hamas officials in Qatar. It's a rare instance of direct contact by U.S. officials with a group designated as a terrorist organization. Israel and Hamas are currently exploring an extension of their 6-week ceasefire that expired on Sunday. Elon Musk, meanwhile, has met this week with House and Senate Republicans on his DOGE efforts. Lawmakers urged the billionaire to communicate more effectively about looming cuts and work with Congress on a package for the cuts. They went on to warn that the actions might be struck down by the Supreme Court. Republicans also expressed frustration about specific cuts like those made among veteran affair employees. The Wall Street Journal reporting this morning that Starbucks' CEO is telling corporate employees, step up, get back to the office, and take responsibility for improving the company. It was Brian Nickel's first address to employees since widespread layoffs last month. Next Wednesday, Nickel will be holding his first shareholder meeting since taking the helm in September. And that's your brief, John.
Danny, thank you. The vibe shift in corporate America is quite something. We heard it from Jamie Dimon. You're hearing it from Brian Nickel. Just think about how it used to be several years ago. Do you remember those reports of that first year, second year analyst or something like that at Goldman Sachs? Having a PowerPoint presentation for partners and saying we're working too hard? Do you remember that?
Yeah.
Oh, I remember
and
that.
I think they got more for their per diem for ordering out if they work too late.
Yeah.
Things have changed. Let's put it that way. They've changed pretty quickly since then.
Let's see how many of those people stick around. And that, I think, is going to be a key question at a time where there aren't a lot of other job opportunities.
Yeah. Up next on the program, the end of dollar dominance.
I think dollar exceptionalism has ended this week. I think you're going to see this flow out of dollar-denominated assets, and I think the dollar comes off from where it is.
That is a huge call from Bob Michael of JP Morgan Asset Management. We'll get reaction from Jane Foley of Rabobank out of the City of London from New York City this morning. You're watching Bloomberg TV. Here's the shape of things this morning. We are negative by 1% on the S&P. We're down by 1.2 on the Nasdaq. Taking the headlines over the past few days, this move in the euro, in a single currency, 3 days, 4% move. Haven't seen that in a decade on euro dollar. Just absolutely amazing. Under surveillance this morning, the end of dollar dominance.
I think dollar exceptionalism has ended this week. Everyone has talked about how expensive U.S. markets have gotten relative to non-U.S. markets, but nobody wanted to step in front of the steamroller. And now the steamroller's rolling the other way, and I think you're going to see this flow out of dollar-denominated assets, and I think the dollar comes off from where it is.
Such a big call from JP Morgan Asset Management's Bob Michael. So here's the latest so far. The dollar on a 4-day losing streak and hitting a 4-month low against the euro as tariff policies weigh on growth expectations. Jane Foley of Rabobank writing, the return of US growth concerns has clearly been a drag on the dollar. However, the change in the fundamental drivers behind the euro have been even more dramatic. Jane joins us now for more. Jane, welcome to the programme. I have to say, we talked about this a little bit earlier this hour. It takes time to internalise a shift this large on the continent. It would take weeks, months, maybe even years. Jane, could you just communicate from your standpoint how large a shift we're seeing from Germany?
Well, certainly it's a significant shift in terms of the news that we've had. But of course, everybody in Europe is aware that things take time in order to come into fruition. And this is a real issue, I think, for the people who've been buying euros, aggressively this week. Is this just a sugar rush, or will we actually have a different determination of the time frame it needs to get this money through from Germany, from the EU, into the economy, into the defence sector? And if there are disappointments along the way in terms of that timing, well, we could see 105 again in euro dollar, and potentially quite quickly, because we know that there are hurdles. We know that if this change in fiscal policy gets through Germany, well, it's with the outgoing parliament. The new parliament after March the 25th could have legal challenges even to this. And then what about capacity? Europe doesn't have huge capacity in terms of defence. How quickly can it actually spend all of this money? So we know that the timeline for Europe could be quite disappointing.
So, Jane, you raised your forecast to euro dollar to 107. You said that you're going to update that by the end of this week. That means you have 1 day to really look at all of the facts and figure out how much is real and how much is overly optimistic. What are you looking at to make that determination, and what's the range of potential outcomes?
Well, I do think anything from the Fed is got to be really important here, because, we're hearing the arguments about the slowing in US growth. We can see also, the stock market and how that in the US could affect confidence for the US consumer. But even though if we were to accept the fact that the US economy is slowing, well, what about inflation? Because, maybe we were a little bit optimistic or pessimistic in terms of the inflation push from tariffs at the start of the year. But tariffs are still inflationary, and even if the Fed is worried about growth, it's unlikely to cut interest rates aggressively if it's concerned on the inflation front. So I think that's a really important part. To what degree are the Fed able to cut interest rates in an environment where inflation has been looking sticky? It was looking sticky because of the Biden month, through the end of the Biden administration, likely to look sticky now because of tariffs. And we just don't know the impact of those tariffs. So the Fed likely to be cautious on that front. So whereas that could give the dollar a little prop higher, it's possible that the worries about timing, about German fiscal spending, could actually knock the euro a little bit lower from the perch that we've seen over the last couple of days.
Although if you take a step back, Jane, I wonder if Bob Michael is onto something and whether you would agree with this idea that more broadly, maybe it's not this week, but maybe it's this month, maybe it's the next couple of months that we're seeing the peak in dollar exceptionalism. And with all of the money looking to be raised elsewhere, there is going to be a sucking sound away from the United States in dollar assets.
Well, I think this is a question really about US exceptionalism, really for the next decade, for the next 2 or 3 decades. Even I don't think it's going to be able to be answered in a very short term. I mean, to me, one of the definitions of US exceptionalism is the fact that the dollar has its own fundamentals, and that derives from the fact that about 50% of the world's invoices are in dollars, and that means that even when negative news comes from, say, the US budget, people need their dollars. They buy their dollars. That's why it is essentially a safe haven. And for that to change, we're going to have this very slow, and it's already started, this very slow progression away from using dollars as an invoicing currency, and therefore, as a reserve currency. That has started. It's quite possible that Trump's policies with respect to Europe, with respect to Canada, Mexico, etc., make people move away from the dollars. But that is a very slow process, and I don't think we're going to be able to answer that question quickly.
Well, what fills the void, Jane?
Well, precisely, and that is why the movement away from the dollar, use of the dollar internationally will be very, very slow. I mean, clearly what we've seen over the last few years is, China wanting to use the renminbi as more of an invoicing currency, for instance. That will carry on, and some of its trade allies will continue to, be pushed in that direction. It is going to be interesting to see whether or not there is a European response over the next 4 years. That perhaps will depend on what happens between Trump and Europe in terms of tariffs, for instance. But again, I think the question about dollar de-dollarization is a very slow one.
Hey, Joan, appreciate it. Jane Foley there of Rabobank on the shifts we're seeing out of Germany, potentially huge. It's got to get through Parliament, but it could be absolutely humongous. We mentioned how long it would take to internalise the shifts that are developing in the biggest economy in Europe. I would go back to July 26, 2012. Then ECB President Mario Draghi delivers a speech in London. And in the middle of that speech, he says, we will do whatever it takes to preserve the euro. Believe me, it will be enough. I was in the newsroom in London that day. I know people who were in the room. And the people who were in the room, some of which didn't really understand how big that moment actually was in the moment. It was only in the days and weeks after that we really got our hands around how big the shift was that we were about to see. I sense something similar in this moment out of Germany, who've used similar language, in fact, precisely the same language, whatever it takes. I think it's going to take a while to truly understand how big the rebalancing we could potentially see in Europe and, for that matter, the global economy and the bond market as well.
Some analysts talking about even a shift higher to 130 in the euro versus the dollar longer term if you do get some of the promised funding. A lot depends on how serious they are, the methods to actually getting there. But honestly, this is a market that isn't fully efficient, because how do you fully price something that still is in its initial incipient forms?
There are some ifs that linger still.
Correct.
I think we should continue repeating that. Up next on the programme, Max Kettner of HSBC, Tobin Marcus of Wolfe Research, Jill Carey Hall of Bank of America, and the former chair of the Council of Economic Advisors, Jason Furman.
staying on top of potential tariff risk is important.
Tariff policy is taking place in such a haphazard way, it ends up creating self-inflicted damage to the U.S.
I think dollar exceptionalism has ended this week.
The economy is still holding up fairly well, although obviously Q1 is looking worse by the day.
I think at the end of the day, the U.S. economy is going to prove resilient.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The declines resume. Your second hour of Bloomberg Surveillance starts right now. We're down 0.9% on the S&P 500. On the Nasdaq 100, we're softer by more than 1 full percentage point. Some weakness as well on the small caps. We'll talk about them later. The Russell, -1 full percentage point. Your day ahead shaping up as follows. 90 minutes from now, we will get jobless claims. Look out for that at 8:30 Eastern Time. An ECB rate decision at 8:15. A news conference 30 minutes later. This one gets far more interesting, given potential developments in Germany. Speaking of developments in Germany, developments in the bond market. 2-year, 10-year, 30-year out of Germany. The German 10-year yesterday up 30 basis points, 3-0. We had another 6, 285.
Which really raises the point that Ollie Crook was highlighting, and I think it was a great one, our colleague out of Europe, which is the ECB doesn't hold the cards anymore. If you want to see who holds the cards, it's the fiscal spending. And that's really going to be front and center. How the ECB responds to it, they're going to hedge. They are going to haw. They are not going to discuss it. People saying this probably will be the last 25 basis point cut, maybe even in the cycle, and they need to start to talk about neutral. But there's a bigger question here, which is, does it concern them that this bond market is raising questions about the capacity to absorb all of this debt while remaining with borrowing costs remaining in check?
That news conference coming from Christine Lagarde, the ECB president, at 8:45 Eastern Time. Look out for that. It's decisions made stateside right here in America that's pushing the Europeans, the German government specifically, to do things they've refused to do for a long time.
Absolutely. Donald Trump has been needling them to raise their defense spending. And of course, the fact that he is at the moment halting a pause in the transit of weapons going to Ukraine. Some intelligence is being withheld. So Europe has no choice, but they are forced to act. And Frederick Merz is saying we're going to do whatever it takes.
Here in America, we're focused on the economic data. The latest data point, 8:30 Eastern Time, jobless claims, payrolls tomorrow morning. Economic data is going to become more and more important. Look out for more tariff deadlines, 25% on steel and aluminum. That's a week away. Then early April, we'll be talking about reciprocal tariffs. The United States going after the Europeans and maybe pushing the Chinese even further.
Absolutely. Tariff roller coaster is how the Wall Street Journal editorial board puts it this morning. 2 key things I'm watching out for today. One, that we know that they're going to get an exemption on auto tariffs. We need to see that actually play up in the executive order, because right now they're technically still in place when it comes to the paper trail. Second, Donald Trump is likely going to get on the phone with Claudia Sheinbaum. Is there a deal that could potentially work out before Sunday, when she says retaliatory measures will come into play?
With all this tit for tat, people are feeling uneasy. And we're seeing that in surveys. We're seeing that in the economic data. And I just wonder how much that's placing an increasing emphasis on economic data that's to the downside and making people dismiss data like the ISM services that came in hotter than expected yesterday. And so to me, it really puts the focus on an asymmetric response to negative news.
Look out for more economic data later on this morning. Coming up this hour, we'll catch up with Max Kettner of HSBC on U.S. exceptionalism. We'll speak to Jill Carey Hall of Bank of America on risk to small caps, and Jason Furman, the former chair of the Council of Economic Advisors, on tariff confusion. We begin this hour with the global bond market sell-off deepening and stocks resuming declines. Max Kettner of HSBC writing, Goldilocks has had a few scratches in the last few weeks. Data misses have started to cast some doubt over the idea of U.S. exceptionalism. However, we'd argue this is precisely what we're looking for. Max joins us now for more. Max, good morning. Welcome to New York. We've got a lot to catch up on. What's that last line about? This is precisely what we're looking for.
I think overall, if we think from a more strategic perspective, then actually this is the kind of stuff you want for US exceptionalism. Because the problem is, think 2 months back, the consensus opinion was you got to buy the dollar, you got to buy US equities. And actually, when we look at anything else, don't even look at it. It's not even worth looking at. It's just the US and nothing else. And here we are 2 months later, and all of a sudden nothing's worked. So one of the key ingredients for both this idea of US exceptionalism, but also the idea of Goldilocks is that you've got these persistent doubts around it. That, people are saying, oh, AI, how are we going to make money with AI? And how about, this big discount of the rest of world equities, international equities versus the US? Isn't the US too expensive? So this perpetual question around valuations. Now, that's the strategic question, right? Then you're saying, hey, that idea of US exceptionalism is not dead. Absolutely not, because we've got lower corporate taxes, the S&P effective tax rate is much lower. Your ROE gap, I think I would always argue, look, you can look at valuations as a really, really negative sign from a strategic, a longer-term perspective in the US. But you can also look the other way around and say your ROE gap between the US and the rest of the world has more than quadrupled in 15 years. So fine, you're paying a higher price, but guess what? You're getting more than 4 times as much profitability. Again, that's the strategic perspective. Doesn't tell us, unfortunately, an awful lot about the next couple of weeks.
This has been the most exhausting 5% pullback I think I've ever witnessed on the equity market on the S&P 500. Do you buy this weakness or chase the strength in Europe with banks up 25% year to date on the Stock 600?
Yeah, I'd rather look elsewhere right now. So we've just put out a note this morning saying, look, guys, probably the US is not the place to be right now, at least tactically, because those tariff headlines are probably not going to go away. I think for the Fed put to come back into action, there simply isn't enough weakness yet, right? So you said this has been the most exhausting 5% pullback, and I feel it. I think all of us feel
Have you ever seen anything like this when sentiment seems to have shifted so much, but the market's only done so little?
It's amazing. I mean, it is. We've actually done some analysis on this week when we look at some of our positioning and some of our momentum indicators. The drawdown that we've seen so far is almost only half of what we would usually see when our indicators go down by that much, right? So you've got a big shift down in those positioning indicators, but normally you'd say, yeah, that's probably like 6-7% down, but by that time it was only 3-4% down.
Well,
so that is exhausting, I get it, but the problem is for the Fed put to come back, we would need more weakness. You're saying 5%, yeah, fine, but is the Fed really going to go in? It's like, oh my God, Nvidia's down, so yeah, we need to cut rates.
Well, hold on a second. There is this question about the journey mattering, and this has sort of been a theme over the past couple of weeks. How much does the journey matter if the destination is a good one? And we're talking about how it's only a 5% pullback, but it can be up 10% and then down 20%, and then eventually we'll get to 5% in one day. So it raises this question about risk-reward models at a time where you cannot model this type of volatility. You cannot model headline risk. How much is that alone pushing capital away from the United States right now?
I think on a tactical basis, yes. I think on a tactical basis, Lisa, that's exactly what you want to do. When we look at the US, if you had predicted what's happening now from a policy perspective in the US, if you had told me that a month ago, I would have said risk off everywhere. Don't buy Europe. Buy Europe even less. Don't buy China. Don't buy EM. No. Don't buy anything. Now you look at it, I'm like, actually, you know what? Europe's really looking great. Like Germany, as a German, I look at this, I'm like, this is as watershed as you can imagine. Right? Like the Germans spending money, and I know that from myself, right? To get myself, I'm in New York, and I'm just like, really? Coffee, $7? I'm like, I'm not going to have coffee. Actually, no, I'm going to go to the Bloomberg office every day, get my coffee for free, and then I'll go away, so I don't have to spend money.
You can borrow money.
You know what I mean?
You can spend it on
but it is genuinely, it is such an extremely watershed moment for Germany. And then you look at the banks, and we've just, when I came in, it's like 25%. Do you still want to buy that? Heck yeah. Absolutely.
So when do you think that the optimism has gone too far? We were just talking to Jane Foley, trying to pour some cold water on this optimism that we're hearing around. When do you know that we're overstating it or understating it? What are you looking for?
Once you stop having the conversations about should we worry and what could stop it, I think then we're there, right? So it's a bit like with the idea of US exceptionalism at the end of December, beginning of January. Once everyone's super bulled up, then yeah, fine, you're probably done. But to be honest, when you look at positioning indicators, when you look at flows, certainly flows have been starting to come back into European equities, but they've only just started. Right? 2 months ago, you'd have said, why are we even looking at Europe? What's the point? Right? What is the point? And now we look at it, I'm like, wow, this is like the best thing ever. It's been 2 months. It might, again, because it's so exhausting, it might feel like 2 years, but it's genuinely just a couple of weeks. I'll give you an example. I was in Frankfurt literally 3 weeks ago. The amount of conversations with clients I've had about fiscal stimulus, about infrastructure and defense spending was zero. Absolute zero. Because 3 weeks ago we're like, never going to happen. Come on, you need a 2/3 majority. Come on, why are we even talking? Yeah, let's talk about the next thing. It's 3 weeks ago. This is this is as watershed as we can imagine. And then you look at, you look away from the US and you're saying, hey, why would I not buy German mid and small caps or European small and mid caps? You look at China, you look at the HS Tech trade, right? The broadening AI trade. You look at China Internet. Yeah, that still makes sense. No? You look at Japan, hey, rates probably going also a bit higher. Japan banks, fine, they've rallied a lot, but with rates maybe going another 25 bips higher than the market is currently pricing. Great, still good for the banks. So you look outside of the US, and there's loads of things happening now that are actually really uncorrelated to the US. Whereas 4 weeks ago, I would have said, if this happens in the US, everything's going to go, correlation is 1 and everything's going down. And it's exactly the opposite, which is in fact really good. We guys have this conversation about correction and exhausting 5%. If we were sitting in Frankfurt, we'd be happy daisy. I mean, we'd be like freaking cowboys right now.
Are you and your Frankfurt German friends thanking the President of the United States for this?
No, I think, that's probably a bit too far. I honestly also don't really care what the
catalyst is.
Sort of the catalyst is. The important thing from a market perspective is, number one, is it happening? Is it likely happening? Number two, is it sustainable? And that looks like it's happening.
You have a lot of conviction, though, that this is happening and will be sustainable. You don't think this is a head fake from the German politicians?
I think we've gone too far for that to be a head fake, right? For that to be like, oh, actually, never mind. Like, we just thought we're going to spend 800 billion.
I know Europeans can be pretty
fine.
fickle when it comes to spending.
Yeah, but that is mostly red tape and mostly bureaucracy, right? That is, and I think that's more the longer term issue. So then we get to your question, like, is this a head fake? Tactically, it's not. Is this a great 3-6 month trade? Absolutely. Is this the watershed moment where we're burying US exceptionalism and the next 3 to 5 years we're only buying European equities and now European profitability is going up relative to the US? Probably no, because you've seen what Draghi was saying 2 weeks ago around implicit tariffs within Europe, that we've got implicitly 45% tariffs within the EU on goods and 110% on services. You look at the EU Recovery Fund, it's the uptake on the Recovery Fund from almost 5 years ago keeps being subpar and subpar, because it's not like corporates don't want it and governments don't want it, but there's so much red tape, so much bureaucracy within the EU, right? That needs to be tackled. That's not going to be tackled with infrastructure and defense spending. But those are two separate things. We can talk about the strategic asset allocation decision, the 7 to 10 year decision, or the sort of 6 month decision where you're saying, is the spending the watershed moment for the next 6 months? 100%.
In 6 months' time, can the bond market absorb it when we're having a real conversation about a massive tax bill going through Congress here in the United States?
I think so. I think, you mean in Germany as well?
I mean the global bond market.
Yeah, global.
Germany's issuing more. US might have to issue more. What does that look like?
But I think Germany traditionally basically starts issuing more on bills. So that actually, at some point, I think will be bringing in natural buyers for bonds. It still means, obviously, as we get more issuance, that probably bonds are going to continue to cheapen versus swaps in the next few weeks and months. But that trade's gone an awful lot already. But, I think I'm not particularly bothered. I think in the US, I'm also not bothered because, we can look always at the government debt side of things. But when we look at the private corporate debt side of things, massive deleveraging in the last 15 years. No? You look at net interest payments of corporates. When you look at those, we're like on a 20-year low. Because, corporates have been hoarding cash, they get the high cash rate, and they've locked in maturities. You look at the S&P, you've got almost 60% of debt that's maturing after 2030. Why would I? When people are like, oh, yeah, but there's all this debt from corporates. I'm like, great, call me in 15 years. I don't care. No? So from that, the corporate sector and the private household sector actually looks way, way more healthy to absorb sort of that bigger issuance.
The Europeans just sound so happy right now, don't they? What a change.
When have you never seen me happy? Yes. I blame the coffee. I blame the free coffee.
No,
so, give the German free stuff and he's happy.
All I can say is watch him go buy a $7 cup of coffee and all of a sudden these fiscal stimulus plans, they're real.
Yeah, come back when it's like euro dollar 120, 125, back to 150 again. Max, it's good to see you.
Thank you.
That'll make a difference. Max Kettner of HSBC. Let's give you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The White House said that it will exempt automakers from tariffs on Mexico and Canada for 1 month, following pleas from industry leaders. The exemption applies to auto parts that comply with the USMCA trade pact. It's intended to give companies time to come up with plans to move more investment and production to the U.S. That announcement pushed U.S. autos higher in yesterday's trading, though most of them are lower in the pre-market this morning. Also moving in the pre-market, Macy's, those shares down 2.25%, reporting earnings about 15 minutes ago. Its sales and profit forecasts were more downbeat than analysts had expected. Macy's says that it's taking a conservative approach on the outlook, given what it called external uncertainties that both the company and consumers are facing. Shares of Marvel are also down sharply in the pre-market, nearly 17%. It expects $1.88 billion in sales in the fiscal first quarter. Even though that was in line with the average estimate, some projections were as high as $2 billion. Those expectations for the chipmaker were high. Investors wanted to see a bigger payoff from the AI boom. And that's your brief. John.
Hey, Danny, thank you. More from Danny about 30 minutes away. Up next on the program, no pain, no gain.
I think for folks on Wall Street who may be concerned, look at what this president did for you in his first term. Wall Street boomed, stock market boomed. The president expects that to happen again, but most importantly, Main Street is going to boom.
That conversation up next with Tobin Marcus of Wolfe Research from New York City this morning. Good morning. Equity softer here. We're down by a little more than 1 full percentage point on the S&P 500. In the bond market, yields are higher by 3 or 4 basis points, 431.48. Look out for labour market data this morning, including 8:30 Eastern Time. Jobless claims just around the corner. Under surveillance this morning, no pain, no gain.
President Trump has made clear, Caroline, that he loves tariffs, but the stock market does not. How does he factor that into his decision making?
I think for folks on Wall Street who may be concerned, look at what this president did for you in his first term. Wall Street boomed, stock market boomed. The president expects that to happen again, but most importantly, Main Street is going to boom, and that's why the president has this whole of government economic approach, which includes tax cuts, tariffs, regulation cuts, and an energy industry that will bring down costs for American consumers.
So here's the latest this morning. President Trump freeing automakers from tariffs on Mexico and Canada for 1 month, buying them time to move more investment and production to the United States. Bloomberg's Tyler Kendall joins us now for more. Tyler, welcome to the program. It's been a conversation up here in New York. I'm not sure what it sounds like down in Washington, D.C. We got a flavour of it just then. How sensitive this administration actually is to stocks, to the equity market, to what happens on Wall Street.
Right. And John, you actually asked Commerce Secretary Howard Lutnick the same question yesterday, and he had responded exactly like the press secretary there, saying that this administration is trying to push forward its broader macroeconomic view here when it comes to deregulation, boosting oil production, and then, of course, importantly, trying to push through its tax cut agenda. That is going to be critical moving ahead, considering that we know that Capitol Hill is already starting to raise concerns here when it comes to getting those tax cuts across and also made permanent, as this White House would like to see. When we go back to the autos, that press secretary right before that question was also asked whether or not this White House thinks it's realistic to actually see significant shifts in production or plans within 1 month's time. And Caroline Levitt responded that President Trump told the big three that they better, quote, get moving. Of course, we're talking about some very complicated supply chains here where we see auto parts move across the border multiple times before a vehicle is ultimately finished. So the benchmark of progress that this administration is looking for is one of perhaps the biggest questions going forward about whether or not this reprieve or other exceptions or carve-outs that we see could ultimately get extended.
Tyler, thank you. Tyler Kendall over in Washington, D.C., out of the nation's capital. Joining us now is Tobin Marcus of Wolfe Research. Tobin, really difficult question to start. Forgive me. Where do you think we'll be a month from now?
Well, a month from now, we will have just gotten past April 2nd, which is the much larger tariff rollout deadline that President Trump seems to have his focus on. You know, the confusion about the timing of the Mexico and Canada tariffs last week, I think, came just because he keeps talking about that milestone as the thing that he mostly has his eye on. You know, there's a ton of variability about what could happen then. He's talked about sectoral tariffs globally on auto, semis, pharma, agricultural products at a 25% rate. And then we have this reciprocal tariff policy that could either be like pretty innocuous if they're only really looking at tariff rates when setting those reciprocal rates. If they're throwing in value-added taxes, as they've said that they want to, you know, then we're looking at a much more dramatic expansion of tariffs globally to the tune of 13 percentage points on kind of global average tariff rate increase.
Tobin, when the president talks about tariffs, though, he's all in. And then the next day, 24 hours, 48 hours later, we see them take a step back. It feels like 2 steps forward, 1 step back. Autos are getting a reprieve. What else do you think will get a reprieve?
It's not obvious to me that anything else is going to get a reprieve. Again, he seems quite determined. Autos were by far, I think, the standout pain point. They were the example that everyone would give you. It's this very high salience industry in the U.S., like a sort of a focus of national kind of pride in our industrial base that had just such obvious possibilities for kind of cascading disruption. If you had, suppliers in Canada and Mexico were saying they were just going to shut down production and cause plants to be idled in the U.S. So, they went after that, but they've not done anything else. And it's not clear to me that they're going to. You look at the rest of the tariffs, the China tariffs are notably more sweeping than last time around. None of the exclusions for particular products, even things that consumers, really can see directly, have been given this time. Now it's just 10% across the board on everything. And I think they do have a real preference to go wide on these.
The Agricultural Secretary, though, Brooke Rollins, spoke to Jenny Leonard and Skylar Woodhouse at the White House yesterday. And this is what she said. As far as specific exemptions and carve-outs for the ag industry, perhaps for potash and fertilizer, et cetera, to be determined, she's hopeful and said everything is on the table. Isn't this politically really the third rail for the Trump administration, especially ahead of midterms when you're talking about the Corn Belt and the red states where agriculture is produced?
Yeah, I mean, obviously last time in the first Trump administration, we saw kind of countervailing subsidies that were meant to blunt the economic impact of the tariffs at that time on farmers. Certainly, I think there was going to be some solicitousness of farmers. But, the message that Trump sent in his joint address to Congress the other day was very much like, it's going to be great eventually. We may need to deal with some disruptions in the meantime. So, I wouldn't rule those out. It's not like it dramatically scales back the tariff regime if we carve out potash or fertilizer or what have you. Those are relatively small shares of total U.S. imports from Canada or anywhere else. So, it could be done painlessly, but again, the fact that it hasn't already been done is an indication, I think, of how much they do want to leave as much of this in place as possible.
A couple of weeks ago, people were speculating on the motivation behind some of the tariff threats and the tariff implementation. Some people said that it would lead to lower tariffs in North America after a renegotiated USMCA. Some people said that it was to encourage different national security issues. And other people said it was because this is a president that actually wants to put on tariffs, wants the higher walls to protect U.S. production. Do we have a clear sense of which it is?
We don't entirely. There's certainly been some continued interchangeability in rationale on these. You hear, even within the same interview, Commerce Secretary Lutnick, for example, will often talk about, you can't just, kill Americans with impunity by letting fentanyl flood into the country, but then also talk about them in terms of economic justifications. And certainly what we've seen in terms of the limited relief so far, that has been very economically motivated. I think that the latter of your three justifications seems closest to what Trump himself is thinking. Even this sort of 1 month delay seems to be intended to kind of dovetail with this larger rollout on April 2nd, which kind of makes these tariffs part of the same overall economic framework that he's been putting in place, particularly since, there's definitely no clarity in Ottawa or Mexico City about what they're being expected to do on fentanyl in order to get these on.
Tobin, we'll find out if he gives us many details, if there is a call, a little bit later. Tobin Marcus there of Wolfe Research. The press secretary making the point, I think it's a valid one, to think about the fuller policy platform and not just trade. They're going to be doing other things as well, deregulation, tax cuts. This conversation needs to shift pretty fast to those other few things.
And they need to get the support of a number of representatives who are facing off with some of the concerns that Annmarie was talking about, which is whether it's DOGE and job cuts there, whether these tariffs affect people in their particular regions and they get the blowback. So it raises this question about how much support congressionally he has for some of these proposals.
And when it comes to Congress, there's a massive to-do list before they start talking about the extension of tax cuts. We might have a government shutdown next week. That is on the precipice of what they're dealing with right now. Then you have the debt ceiling in the summer, and then they're going to have to fight it out when it comes to the extension of TCJA.
There's an ECB meeting taking place right now. There's a decision at 8:15 Eastern Time. 30 minutes after that, there's a news conference. In 2 weeks, the Federal Reserve has got to put out forecasts. Keep repeating that, March 19th. That's going to be very difficult to do. In just a moment, we'll catch up with Jill Carey-Hall of Bank of America on the potential impact of tariffs on small caps. That's next. This is Bloomberg. Let's check out the equity market. Equity futures down here by 1 full percentage point on the S&P 500. On the Nasdaq, we're down by 1.26. Yesterday, we snapped a 2-day losing streak. The losses resume. We're down by more than 1 full percentage point on the Russell. We'll talk about the small caps with Jill Carey-Hall in just a moment. I want to turn to the bond market. 2-year, 10-year, 30-year yield. Yields on a 10-year this morning higher by 3 or 4 basis points. The 10-year 431.29. We're up by 4 on 30s to 460.94. At the corner of my eye, a data point that we don't typically break or typically see. Let's get over to Mike McKee and try and bring Mike in on this data. Mike, challenger job cuts is a data point that maybe we look past. Not this morning.
Not this morning. This is going to catch people's attention. And Lisa, you've been asking, when are we going to see Doge in the data? This is the first black cloud on the horizon, I think. 172,000 job cuts announced. That's a more than 100% increase over the last month. Now, Challenger breaks it down this way, saying government jobs, they've lost almost 62,000. Then consumer products and technology also contribute to this. Education jobs down by almost 3,000. And that may be part of the NIH situation. Now, the second biggest is retail. That doesn't have anything to do with Doge, but it probably does have to do with the 20,000 employees at the Joann stores, which are going out of business, and also some store closings from Macy's and Kohl's and others. So while this data probably won't show up in the February number we get tomorrow, we are setting ourselves up for a very interesting March. I do have to caution that job cut announcements don't necessarily mean that many job cuts, because maybe they're filled through attrition or maybe they don't happen over a period of time. So we don't usually pay a lot of attention to Challenger, as you said, John. But in this case, it's a number that certainly feeds the narrative we've got these days.
And Mike, it's only one half of the ledger as well. Job hirings, of course, is another part of the picture we need to discuss. But Mike, for a number of months, we've had a very low churn dynamic in the labour market. That's a phrase that Andrew Hollenhorst of Citi has described things by, because hiring has been quite low. And we've also seen firing soften as well. Quits have softened up as well. This freezing of the labour market has really taken hold over the last number of months. What would explain something like this?
Well, it may be combination of the Doge effects in Washington and then sort of a churn you get at the beginning of the year as companies reset. You mentioned hirings. Hirings were up quite a bit, 34,580 compared to just over 6,000 in the month of January. And there's always a lot of churn in the labor market, but now it's the job cuts that are getting the attention because everybody's seeing this story play out day after day. We've got in an hour coming up the jobless claims numbers, and that's going to be interesting to see because we should start to see there some of the federal workers' numbers show up in the data.
Your tone is the correct one, Mike. I'm saying as markets really don't respond massively to this, it hasn't been a data point that has been looked at as a tradable one for a while. I am curious, though, this in particular, planned cuts last month were the most for a February since 2009. That kind of forward look, is there some tell in that kind of tone from these challenger job cut data?
Well, certainly it suggests that there is something going on here. Now, what is interesting is all these Doge numbers basically have not been announced. They've just been happened. I mean, we get told after the fact that all these people get laid off. So a number of these may be in private companies who are contractors for the government, and that would suggest that there is more going on underneath the surface that we need to pay attention to.
I feel like Lisa today, because I keep referring to the Beige Book yesterday, but I actually, for the first time, I think in ever, I thought it was interesting. The Chicago district said there were many contacts that reported having little trouble filling positions. One contact in retail said they had, quote, resumes stacked to the ceiling. How quickly could the labor market really start to crack, Mike?
It could start to crack quickly, although at this point, it's really about the psychology of growth. If the companies out there start thinking about a recession and start trying to plan for one, you will see a lot of cuts right away. What John said earlier has been holding, that companies are just sort of not hiring, but they aren't letting people go. If that's going to change, then that's something that the Fed has to worry about.
Mike McKee, appreciate the breakdown. We'll catch up with you again in about an hour's time. Mike McKee on jobless claims at 8:30 Eastern Time. I think a little additional weight adds to the importance of jobless claims later this morning. Just to go back over that data, the Challenger job cuts, the announcements totalling just north of 172,000 in February, a 103% increase from last year. That increase the most since 2020. I think we have to recognise it's only one half of the picture. The other half is hiring. Hiring picked up as well. But it's interesting to see things start to loosen up in the labour market, to Mike's point, and I said it earlier. Things had frozen up a little bit. Not so much anymore, based on that data point.
There has been a shift, and we see it in the headlines in terms of Doge job cuts. This is interesting to me, and especially the market reaction that isn't that significant. And I wonder how much some sort of negativity in the jobless claims data will also be shrugged off as some of the Doge effect. At what point does it suggest some sort of broader weakening? And I think that is a question that can only be answered by corporations and some of their forward guidance.
These are plans, not necessarily going to see the actual layoffs take place. We'll see what happens. Could be a head fake. I don't know. But every single day, as we get more data and build a fuller picture, Lisa, we've got to keep going over the data points as we get them. We'll get another one in about 55 minutes.
And that's going to be really important to see in terms of initial jobless claims. I do wonder, the idea that we keep talking about how federal employees are a pretty small number, but the contractors are not. We have to add to that the uncertainty that tariffs cause for smaller companies that are dealing with much smaller margins and that anecdotally are looking around and saying, if this goes on and the uncertainty, the longer it keeps going, the more we have to retrench our headcount.
Stocks have got to deal with that as well. We're lower by 1 full percentage point on the S&P 500. Tariffs, job cuts, got to talk about equities. Jill Carey-Hall of Bank of America remaining cautious, saying small caps are more at risk from tariffs given their thinner margins. Deregulation should be bullish for parts of small caps, but the macro backdrop will remain important as well. Jill joins us now for more. Jill, good morning. It's good to see you.
Good morning.
What happened to all the bullishness on small caps in November after the election? Where did all that go?
Well, I think, we going into the year, we've been cautious on the Russell 2000 despite some investors' bullishness. And I think, the economic backdrop, if that remains supportive, is obviously a positive. And if we see deregulation, that will certainly be a positive to pockets of small caps and many pockets of the market where it's not necessarily priced in, we think, in sectors like financials. But I think there's a couple issues with the Russell 2000 right now that still make it challenging. I mean, a year ago, everyone expected that small caps would see a bigger earnings recovery and would see very strong earnings growth. That keeps getting kicked down the road. And, this earnings season, we haven't really seen any evidence that make us feel very confident in that strong earnings recovery that consensus has been expecting. The corporate guidance from companies has been weak in both large and small caps. And part of that may be seasonally. Usually corporates do issue weaker guidance in January and February. But the commentary on earnings calls, even though it was very positive for larger companies in terms of corporate sentiments when we look at positive versus negative words on the earnings calls, it was very negative for small caps. And the spread between that corporate sentiment measure for small and large was actually the most negative we've seen in our data history going back to 2004.
This is important at a time where big companies might have the negotiating power of, say, Walmart, that can go try to jawbone some of their suppliers down to lower prices by 10%. How much thinner are the margins? Can you give us any sense of what you're seeing in terms of how susceptible and how more susceptible some of these smaller companies are to some of the tariffs?
Right. I mean, I think the Russell 2000 has been challenged in that, it's been in this earnings recession since 2023. It hasn't really climbed out of it yet. These companies have thinner margins, as you mentioned, and, we've seen just a record proportion of non-profitable, non-earner stocks within the Russell. So the fundamental backdrop has been a lot more challenged. And, at the same time, as interest rates had risen, the debt profiles of these companies have been a worry. So, if we see higher import costs for these companies, the potential earnings hit for small caps, if we assume a scenario of the current tariffs on Canada and Mexico and China, and then we assume, retaliation, this could be about 3 times as much of an earnings hit for smaller caps in the Russell 2000 as it could for the S&P 500.
Some people, and just a contrarian view to push back, would be that yields are actually going lower in the United States, even as they climb everywhere else. You are seeing lower borrowing costs as a result, and you also are going to get an extension of tax cuts that could potentially be better at a time where less regulation could also lead to that M&A boom that's been iced for now. How much can that offset the hit that you were just talking about?
I think, this will definitely be a benefit to pockets of the market. So I think there's been a broad view that, okay, the M&A will pick up and this will benefit the Russell 2000. We haven't necessarily seen that historically. The Russell has actually underperformed more frequently in years. M&A has picked up a lot than outperformed, often because the market's already run up and valuations were more extended. Maybe not necessarily the case for the Russell now, but valuations aren't necessarily cheap anymore. So I think, the macro backdrop, cost of capital, there's going to be other drivers beyond just who chairs the FTC for M&A. But I do think, when you see M&A pickups, it does tend to benefit pockets of small caps, whether it be areas like staples or healthcare. We've seen a pickup there. Financials, we expect that area to see an M&A pickup. Deregulation, we didn't necessarily see small caps outperform during the last period of deregulation because of the other factors that were going on in terms of trade and a manufacturing recession. So I think the manufacturing backdrop will be important. We are expecting a manufacturing recovery. So looking at the ISM and some of the other data points, many of them are still supportive. Some of them have been a bit more mixed, but that is something that would be supportive of small caps broadly. But I think all of this suggests that you want to pick stocks. This is a backdrop where there's a lot of different baskets and pockets of the market that will be behaving very differently based on a lot of these factors that we're seeing right now, whether it's trade or immigration or manufacturing, bullish themes like productivity and reshoring. So, stock selection is going to be more important, we think, than just buying an index.
The president said, he was honest, he said it's going to be disruptive and we can live with some of that pain. Are you potentially saying you'll become less cautious when potentially some of the better policies that Lisa's pointing to, tax cuts, deregulation, come into play maybe later in the year? Is the sequencing what's hurting the small caps?
I think, if some of the policies that could potentially impact earnings more in terms of tariffs or immigration, where small caps are a more labor-intensive size segment, are front-loaded, that certainly can impact, the size segment more. And also if it just creates uncertainty for corporates, and at a time, like I said, when some of these companies have still been trying to get out of this earnings recession. We think mid-cap companies, within the SMID umbrella actually look better positioned. They're better positioned fundamentally. They've seen earnings revision trends turn positive. They have cleaner balance sheets, better fundamentals, potentially less earnings risk, better margins in terms of the risks from tariffs.
How often are clients asking about Europe right now? How much has changed on that front?
Well, I think, there's obviously a lot going on globally, and the U.S., we think, in terms of the S&P 500, still looks like a high-quality area. And, the S&P 500 is obviously expensive, but, that's one reason that we think the equal-weighted index within the S&P and large-cap value, there's, potentially less extended positioning and valuations and more upside for some of the cyclicals in that pocket of the market.
Joe, appreciate your time and the clarity on the stock market. Jill Carey-Hall there of Bank of America. I remember a conversation I had with a guest a long time ago when I first moved here, so the best part of 10 years ago, and they came on set and I asked about Europe, and they said to me that Europe was good for vacations and not for investing. That conversation's changed pretty quickly at the start of 25.
I was actually wondering, as you were talking, and the fact that you brought it up in your response, I'm thinking you kind of flip it on its head. Now maybe it's good for investing, but I'm kind of glad I got my European vacation.
Not so good for vacations at 108? You're complaining about 108?
Well, I'm not complaining about that, but people talk 130. You were mentioning 150. What?
The 130s, 140s again. I wouldn't be happy about vacations in Europe at those levels again.
I lived there at 134 in Rome.
Don't want to repeat that. I'm happy around 110. I think that's a nice compromise.
I'm glad.
Not that I've got any skin in the game. These aren't trade recommendations.
Keeping the Pooja trip at 110?
These are not trade recommendations, OK? Jill, it's good to see you. Let's get you an update on stories elsewhere this morning. Here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. German bonds are extending their decline this morning of about 5 basis points. That follows the biggest sell-off since German reunification in the 1990s. At one point, 10-year yields hit 2.93% this morning. That is the highest since October of 2023. Driven by a sea change in Germany's spending plans, the bond sell-off has gone global. Japan's 10-year yields, for example, crossed 1.5% for the first time since June of 2009. Elsewhere, sources tell Bloomberg that Walmart has asked some Chinese suppliers to reduce prices by up to 10% in order to offset the cost of President Donald Trump's tariffs. Suppliers had pushed back, citing already thin margins and concerns that further price cuts would lead to losses or compromise product quality. The Wall Street Journal reporting that President Donald Trump is expecting to issue an executive order that would abolish the Department of Education as soon as today. A draft of the order, viewed by the Journal, directs Education Secretary Linda McMahon to take all necessary steps to facilitate the closure of the Education Department. The White House has not yet responded to a request for comment. And that's your Bloomberg Brief. John.
Danny, thank you. More from Danny later on this morning. That story won't go away, will it? Keeps lingering.
It keeps lingering, and they want to put education back into the states. The issue is there's a number of grants, students that have special needs, some of that money, and also it gets appropriated in Congress. It's going to be a lot of fights between DOGE and Congress.
Interesting read in the Journal this morning. Up next on the program, tariffs fueling economic fears.
Some tariffs will come on right away, and then some tariffs will be registered, and they will take 3 weeks or 4 weeks. So there's a process for tariffs in America. Once it's in, they will stick.
Jason Furman, the former chair of the Council of Economic Advisors under President Obama, joins us next from New York. This is Bloomberg. Live from New York City, welcome to the program. Equities down about 1 full percentage point on the S&P 500. A data point came out about 20 minutes or so ago that we wouldn't typically talk about. Challenger job cuts. According to data released from that firm just moments ago, reporting an increase in job cuts, a 103% increase from last year, the most since July 2020. Only one half of the picture. Hiring also picked up, but this data that comes out, Lisa, is going to get more and more attention over the next few days.
This data has been influenced by some of the DOGE cuts in Washington, D.C. federal workers. It is showing up. But the fact that we just saw the biggest print of job cuts and expected job cuts going back to the Great Recession is definitely something fueling a tone.
Under surveillance this morning, tariffs fueling economic fears.
Some tariffs will come on right away, and then some tariffs will be registered, and they will take 3 weeks or 4 weeks, and they will come on in due course. So there's a process for tariffs in America, but we will announce them, and we will be negotiating with all these countries thereafter, and then they go into effect over a period of months. Once it's in, they will stick.
So here's the latest this morning. Markets looking for more tariff relief from the Trump administration, delaying levies on auto imports for a month. Jason Furman of the Harvard Kennedy School writing, "I've rarely seen an economy turn negative as quickly as this one has. But people shouldn't get over their skis. I expect all of this to slow growth and add to inflation, but don't expect anything dramatic in the data right away." Jason joins us now for more. Jason, welcome back to the program, sir. And I'm totally with you. I think we all are. This shift we're seeing in sentiment in just a month, so big and so quick. Where does that more constructive tone come from at the end of that quote there? Why should we ultimately avoid anything too dramatic?
Look, there's no debate that the Trump administration's impact on the economy has been negative. Just about everything they've done has been negative for the economy and is going to hurt it. You can debate the magnitude. And partly I'm reacting to, there was the Atlanta Fed's GDP Now said that the economy was cratering in the first quarter. I think that number was flawed. Things move slowly. You know, consumers are really, really nervous, but my guess is that they're probably still spending and they're going to wait and see how things turn out. So the types of problems we're seeing now, they take time to build. They don't just go straight to recession.
Jason, we do have a carve out, though, for the auto sector, and there's lots of conversation. Maybe agricultural will be next. If you're USMCA compliant and you get a carve out, basically, does that mean these 25% tariffs came and went? And what's the impact going to be?
You know, there's tariffs that are going to come, there's tariffs that are going to go, and then there's more tariffs that are going to come back. I mean, you just showed Howard Lutnick. He expressed pretty clearly that there's going to be more and more and more. And as he just said, they're going to stick. So, yeah, you can do carve-outs, but there's still lots and lots and lots of tariffs on Canada and Mexico. And remember, you know, we're less than 2 months in to this administration. In Trump's first administration, it took him nearly 18 months to get to the first set of tariffs. That was after an extensive and judicious process, and it was on a much smaller set of imports than anything we're seeing now.
What do you make of the April 2nd argument that they're looking for reciprocity, basically trying to make sure they can rewrite the rules of trade so that it actually is, in their mind, free and fair?
We already have reciprocity. If you look at other rich countries, their tariffs against the United States tend to average about 1-2%. Our tariffs against them average about 1-2%. On average, they're the same. Now, there's some things they have higher tariffs than we do. Some things they have lower tariffs than we do, but they average out to about the same. So we have reciprocity. If they want to sit down and do a free trade agreement and get those tariffs from 1 to 0, I'd sign up and be wildly enthusiastic.
Jason, you said that it takes time. This is a barge, and to shift the U.S. economy will take more than just a couple of weeks of bad sentiment. At what point do you think that we'll actually start seeing some of the uncertainty and some of potentially the expectation of higher prices begin to show up in the economic data, the hard data?
Yeah, I mean, I think you're going to start to see it right away, but it'll start pretty small and grow. Some of what I'm most worried about here is actually what it does on a 5 or 10-year time horizon when you're talking about how businesses think about their integrated supply chains, how they organize themselves to have maximum efficiency. Now they're going to have to think how they organize themselves to be resilient against an extremely uncertain political system. But I think you'll start to see it a little bit right away, but it'll really grow. And of course, it depends on, do these tariffs escalate or do they end up dropping all of them? And of course, anything is possible.
This is a pretty significant regime shift, at least when it comes to tariffs. And yet what we've been talking about a lot of this morning has been Europe and has been China and has been what's going on there with respect to fiscal stimulus and supporting their defense sector. And it's raised this question that J.P. Morgan's Bob Michael raised yesterday, where he said, we saw the peak in U.S. dollar exceptionalism this week. Do you agree with that? Is that something that you're seeing in terms of the slow drip feed of rearranging supply chains and even maybe invoicing that we see around the world?
I feel pretty good about the dollar and pretty secure about the dollar, although if you wanted to do something about dollar supremacy, you would throw a massive amount of uncertainty into the U.S. economy, which is what we're seeing right now. But I think even that won't be enough. And look, what we're seeing in Europe is good. I'm glad that Germany is untying its hands. I know that's a little bit for the bond market to adjust to up front, but absolutely the right move. And Europe has been behind in spending on its own defense. They do need to shift to something more like closer to a wartime economy so that they can really be in a better position to defend themselves.
They've been massively behind. Jason, it's good to hear from you, as always. Jason Furman there of the Harvard Kennedy School. I think you referred to the US economy as a barge, more like a supertanker, right? Very, very difficult to maneuver. Things don't happen very quickly.
I like the reality check, saying, look, people can feel bad, but they still go out to eat, they still buy sweaters, they still buy watches. And that is what we're seeing right now, at least if we look at the services data. Question is that drip feed and the 5 to 10 year outlook, and how do you even begin to model that at a time where we're focused on what could happen in the next 2 minutes?
And maybe the market's getting over their skis because the headlines have been like a fire hose, and they have been very quick. The problem is you do with tariffs, at least the administration taking a step forward and then one back. And the problem is you just don't know how far back they're going to take some of these measures.
We're focused on the next hour of programming. 8:15 Eastern Time, ECB interest rate decision. 8:30, jobless claims. 15 minutes after that, a news conference with Christine Lagarde. Coming up, Andrew Slimmon of Morgan Stanley, Pooja Kumra of TD Bank, Constance Hunter of the Economist Group, and David Rogal of BlackRock. From New York City, with equity futures down 1 percentage point, this is Bloomberg.
Welcome back to another special BNP Paribas Open update for Bloomberg TV and radio from Tennis Channel. Former world number 1 Naomi Osaka was taken out by Camila Osorio in the biggest upset of day 1 in the desert. The victory was one of the biggest of the Colombian's career. Denmark's Clara Tolson stands between Osorio and the spot in the 3rd round at the 5th major.
we've had a really good run in asset prices here.
With another round of tariffs coming and the blizzard of policies that come out of Washington, there's going to be a lot of volatility.
The key downside risk from our perspective would be if the tariffs wind up amounting to more than we had anticipated.
I think people pull out, the valuation questions are there, and we have this erratic policy that's too hard to invest.
We're probably going to get some pullbacks, high valuation, slower growth, policy uncertainty.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
The third hour of Bloomberg Surveillance starts right now, and your next 60 minutes looks like this. At 8:15 Eastern Time, an ECB rate decision. 15 minutes later, jobless claims in America. 15 minutes after that, we'll have a news conference with the ECB president, the central bank president, Christine Lagarde. Look out for that later on this hour. Your scores at the moment look a little something like this. Equity futures near session lows. We're down by 1 full percentage point on the S&P 500. On the Nasdaq 100, we're down by 1.4. Check out the bond market and look at the front end of the yield curve. Yields down again by 6 or 7 basis points. It's a break of 4%. It's 3.9384. And Lisa, the economic data becomes more and more important this hour.
What we can do is basically flip the whole script coming into this year right now during this week, where growth was strong in the U.S. and going to be weak everywhere else. Suddenly, that is no longer the case. You have Europe, which is investing in a fiscal spending package that we haven't seen yet in terms of confirmation, but is certainly being priced into the market. And in the U.S., we just got challenger job cuts that highlight the potential pain from the federal layoffs and really sets up these initial jobless claims that we get in about a half hour time.
We've had some conflicting data over the past week or so. Consumer sentiment dropped back. A lot of people blamed tariffs. We saw the same thing in ISM manufacturing. Within the survey, the respondents pointed to trade uncertainty. ISM services, bit of a relief on that front. Beige Book overall, the tone was decent still, just about okay. Jobless claims is important, payrolls even more important. Tomorrow morning, we're still looking for 160 on payrolls.
And a lot of people are looking past disruptions that could be tied to what we see in Washington, D.C. You can see that with a pretty muted reaction to today's numbers from the jobless announcements from the challenger front. I just am curious about at what point people are discounting the good news and focusing on the bad news because they're looking for the high-frequency data that isn't really going to confirm it in the same degree that a lot of people are feeling it.
I think they just want the clarity. Tell us what the tariffs are and on what. Is it 5%, 10, 15, 20, 25? Is it on autos, off autos? Why do we have to go from one day to the next not really knowing? Just give us some clarity so we can plan. We came into 2025 with lots of confidence. These companies want to hire. They want to invest in America. They're anticipating tax cuts still to come later this year. It's that volatility around policy which is unhelpful.
Well, it's a feature, not a bug. And throughout this entire process, Donald Trump, the negotiator, has actually been able to get concessions when it comes to Mexico and Canada on things like the border and on things like fentanyl. The issue is, of course, the pullback in the stock market and the fact that now we're already seeing the autos get. Technically, they said they're going to get a carve out. We need to make clear, I'm waiting for the executive order to drop, that it's actually been amended. But now the conversations are, well, what about every other sector that is USMCA compliant? So what I'm most looking forward to today is not the ECB, but Scott Bessent, the Treasury Secretary, speaking at the Economic Club of New York at noon.
A little bit later on this afternoon. Coming up this hour, we'll catch up with Andrew Slimmon of Morgan Stanley on when it's time to buy stocks. Pooja Kumra of TD Bank on today's ECB decision, and David Rogal of BlackRock reacting to US jobless claims. We begin this hour with higher bond yields and stocks resuming declines. Andrew Slimmon of Morgan Stanley writing, I think this is a time to get incrementally more bullish. We have seen a dramatic risk off. I think we can now increase our exposure to risk on stocks. Andrew joins us now for more. Andrew, welcome to the programme, sir. It's good to see you. We said earlier on the programme, the most exhausting 5% pullback I can remember. Andrew, why is now the time to buy?
Well, I think that it's a 5% pullback, but you've had a series of stocks that were very speculative in nature, and they've really pulled back hard. And, you know, if I was on a month ago, I would have said, look, I'm worried there's too much enthusiasm for these, you know, kind of go-go growth stocks, and they've been actually taken to the shed. So I think this is going to be the story of this year, which is it's more of a trading market. I think the market will end the year, you know, fine, but it won't be as good as it's been the last 2 years. That's like you're not going on a limb. But the problem is the market's open, 250 days a year. And if you get a single digit return, that's a lot of movement around a single digit return. So what Lisa said before, I think is right, which is sentiment is very washed out now. It wasn't a month ago. And, you know, it's a time to get incrementally more optimistic. My experience, I've been in this business a long time, Jonathan, you fade DC when people are too optimistic about DC, and you get more optimistic when people get very negative about what's going on in DC.
Well, Andrew, I want to understand that this is fine. It will be fine by the end of the year. What's the strategic anchor that gives you the confidence by the time we get to the end of the year, things will be fine?
Yeah, two reasons. Number one is I'm not as convinced that earnings are going to collapse. You saw fourth quarter was very good. We haven't even begun to factor in the possibility of tax cuts. Now, you may say, oh, it's never going to happen, but no one's factored it in. And so I think earnings are going to come through. The problem is the multiple is too high. The story of American exceptionalism, when you really think about it from a multiple standpoint, has been that we've had these big tech stocks that were capital light, and that's what drove the multiple higher. Well, you know what? They're not capital light anymore. They're spending a lot of money. So I think the story will be that earnings will come through, but maybe the return won't be as good. It will bring the multiple down. And the other thing that I think is key here is that we really have only seen flows from retail turn positive second half of last year. 8 trillion, 7 trillion, whatever the number in money markets, that was the hottest product until the second half of last year. So I think there's a lot of liquidity, and you have the Fed cutting. So I don't think it's a negative year. I just think we're coming off two very good years, and we need to play catch up on the multiple.
Andrew, I hear you, and there is a lot of liquidity out there. And 2 weeks ago, people would say, where else would it go other than the United States? But suddenly there's a competitor. And suddenly there is a story that's not just about policy uncertainty in Washington, D.C., but about fiscal spending in Germany, fiscal spending in China, and the potential of bright shoots elsewhere. How much does that change your equation?
Yeah, I mean, I think that's right. I think there are other alternatives, and I think that would be reflected in the multiple, not as much necessarily in the fundamentals. So yes, I think China is very intriguing because you're seeing these companies fundamentally, they're beating numbers, right? Their multiples are a lot lower, and now you have a government that has done a huge pivot and is now embracing. However, as an investor, you have to be a little bit cautious on there will be noise coming out of Washington, D.C. and Beijing. So I think it's a place to incrementally increase your exposure relative to the U.S. And I think Europe is intriguing also, although I can't help but wonder whether Europe is kind of like China was last fall, where you get this big pivot on hope, and then kind of some of the reality set in, and maybe there was too much enthusiasm, too immediate. I think there's a chance that, let things calm down a bit and then go back in and, look for opportunities. That's what we did in China. We didn't chase it last fall, but as the stocks started to come back down, and then once that pivot, that meeting with Xi, that was really the time to step in.
Andrew, there's a link between what we're seeing in terms of Chinese tech stocks and what we're seeing here in the U.S. this morning with U.S. tech stocks, in particular NVIDIA, that are getting hit hard yet again. And I wonder how much the story, if we didn't have the stuff going on in D.C., if we didn't have the potential fiscal spending in Europe, would it be about some new advancements made by Alibaba, by Manas AI, talking about the DeepSeek moment on steroids and saying they can do more with less and suddenly come out with these models? How much does that challenge the U.S. tech companies that are spending, as you said, that aren't capital light?
Yeah, I mean, I agree with that. And then the problem is you have a multiple differential between the hyperscalers and the Chinese tech stocks. But I'm a believer in the big semiconductor companies because there does seem to be this advancement. Morgan Stanley just had a tech conference. I heard nothing but good things for the NVIDIAs of the world. And so I do think there is an opportunity there. And look, going back to the original question from Jonathan, I think you have to look at companies. What companies have just had big pullbacks that are fundamentally doing well? And I think there's some of our tech stocks are in that range. I just think these very big mega cap tech stocks, they have a spending problem for their multiples, and that's what's going to keep the cap on the S&P this year.
Andrea, you mentioned the Fed and that the Fed's going to be cutting rates and that that's part of the bullish thesis that you have underpinning the reason why you are optimistic and you are still risk on. How much does that get challenged by some of the commentary we've heard from Fed officials that they're trying to balance the potential for higher inflation on the heels of tariffs with potentially slower growth?
Yeah, I mean, look, I'm not a Fed, expert. I'm a portfolio manager, but I just look and say, look, if the economy starts to weaken, the Fed is going to step in. I don't know if the timing will be perfect, so it doesn't mean you can't get drawdowns. Again, going back to, I suspect it's early in this year we'll get a 5% pullback. I suspect we'll get a rally, and then we'll get a bigger pullback at some point this summer. But I think the Fed has equity investors back. It's the Fed put, which is they will, if we see more meaningful cuts, if there's more uncertainty out of Washington, a la tariffs, that creates, kind of concern amongst companies, I think the Fed will step in. And
Andrew, it's interesting you say that. Can I just jump in? Because when they talked about increased uncertainty at the end of last year, it actually led them to raise their inflation forecast, not drop it. It actually led them to reduce the amount of cuts they forecast, not increase them. And I just wonder why that's going to change sometime soon.
Because last year, the economy was doing really well. And, you saw fourth quarter numbers came in great. But my point is, will they pivot? I don't think they'll need to. I think the economy will have to stay in. But to answer Lisa's question, my point is, I think the Fed counterbalances what's going on in Washington. Washington really steps on tariffs, really steps on that hurts companies. I think the Fed incrementally gets more dovish.
Andrew, appreciate your time. Thank you, sir. Andrew Slimmon there of Morgan Stanley. Check out the bond market. Rally at the front end of the yield curve. We're down about 7 basis points on a 2-year, 3.93. in America. Keep an eye on that. Let's get you an update on stories elsewhere with your Bloomberg Brief. Here's Danny Berger. Hey, Danny.
Hey, John. Just that latest data. You mentioned U.S. employers announcing the most job cuts since 2020 last month. That's according to data from Challenger Gray and Christmas. The government sector saw the biggest reduction with nearly 62,000 workers laid off, thanks to DOGE. Overall, job cut announcements increased 103% in February compared with the year prior. It also comes before jobless claims data, which is due out in just a few minutes, and the payrolls report out tomorrow. Alibaba shares rallying after it unveiled its latest open source model. It is a big leap over its previous versions while just using a fraction of the data that DeepSeek's R1 uses. Alibaba has pledged to invest more than $52 billion on AI infrastructure over the next 3 years. And a check on Kroger shares in the pre-market. Those are down about 1/3%. The grocery store chain reported fourth quarter sales of $34.3 billion, just shy of analyst estimates. It is the company's first report since its former CEO, Rodney McMullen, resigned Monday following a personal conduct probe. And that's your brief, John.
Danny, thank you. Thank you very much. Up next on the programme, an ECB rate decision, plus Pooja Kumra of TD Bank here to react from New York City. This is Bloomberg. ECB rate decision just dropping, coming in at 250. The estimate was 250 on the deposit rate. The previous number, 275. So that's a 25 basis point reduction as anticipated. So no big change there. Get to some of the other headlines elsewhere. But just to set the scene, the attention has shifted from monetary policy to fiscal policy in a big way over the past few days. And that's driven yields much higher across the continent as we anticipate a big loosening of the fiscal push out of Germany. What does that mean for this market? Just to touch base with the FX market, euro dollar back through 108. We're positive by 1/4% at 108.18. Lisa, what are the headlines?
To me, the fact that the ECB said that monetary policy is becoming meaningfully less restrictive is the initial move towards saying that we are closer to a neutral rate. This is going to be considered the baby step toward maybe shifting to a pause at a time where, as you said, fiscal very much in the front and center, otherwise saying that the disinflation process is well on track and that wage growth is moderating as expected. So here's the question. At what point are they setting up for a pause, and how much does fiscal factor into that?
Let's get to the team coverage. Bloomberg's Lizzie Burden joins us now out of Frankfurt alongside Ollie Crook in Brussels. Lizzie, first to you. Let's get to the decision. Go through the details, what you're looking for from the news conference in 30 minutes' time.
Well, John, this is what was expected in terms of the decision, but the focus very much on the path ahead. And Lisa, you bang on to focus on this language around the restrictiveness of policy. They're saying that it's becoming meaningfully less restrictive. So they've not quite dropped the language. If they had dropped it, it would have suggested an end perhaps to cuts. Maybe this suggests a pause to cuts. And it's not quite keeping it fully, which would have suggested that you'd have another cut in April. So keeping their options open because there is just so much uncertainty, both on the tariff front and on the fiscal front. Friedrich Merz has pledged to do whatever it takes when it comes to defence and infrastructure spending. You've talked about the massive impact on the bond market, and I'm sure that that's going to come up in the press conference with Christine Lagarde. How much is the ECB going to do to support all that spending? And what if you see these spreads widening to the point that actually you do need the ECB to step in with the transmission protection instrument?
In the ECB's words, uncertainty is rising. And Ollie, some of that uncertainty comes from where you are on the fiscal front.
Yeah, absolutely, John. I mean, I think it would be very interesting to see what Christine Lagarde has got to say in the press conference. You know she's going to get pressed on this. I mean, if we're talking about the Germans basically pumping €1 trillion into the economy over the next few years through sort of infrastructure and defense spending, that is going to obviously have material effects on a number of different things, not just borrowing costs, but, heating up the economy. What will it do to inflation? I mean, we talk about the labor market. I interview a lot of CEOs from the defense space. There's a sort of real lack of skilled labor in order to, if you want to actually build out all of these developments. There's some of them are taking full teams from the auto sector, which is in a cyclical downturn, going into defense. I mean, this has really the potential to really rewire the European economy in a major way. And again, we'll get in a few hours' time now the sort of fruits of the discussions here. How many hundreds of more billions are going to be unlocked at the EU level to be sort of pumped into the economy, to say nothing of the fact that if they do actually loosen those fiscal rules at the member state level, that's going to have big national consequences as well.
Ollie, appreciate your time. Ollie Crook out of Brussels alongside Lizzie Burden in Frankfurt, Germany. More from Lizzie later on today. She's in Frankfurt, Germany. That ECB news conference is about 25 minutes away. There's a line from the ECB that's just dropped, not pre-committing to a particular rate path. That's a line you hear a lot from the European Central Bank, but it takes on a whole new meaning. Only a month or two ago, I would say maybe even only a month ago, we thought, and maybe there was a really strong argument for this ECB to need to get accommodative, to cut rates even more aggressively. Here we are a month later, and the ECB is in absolute no man's land because the German government is looking to push through a big easing of fiscal policy.
Honestly, I can't even imagine how Christine Lagarde is going to give any guidance at a time where, if you take a look at their forecast, they lowered their economic growth forecast for the Euro region in 2026. They also lowered the inflation forecast going forward, but increased it this year. At the same time, we don't understand what the implication is going to be from tariffs. So on one hand, you have the great divide of suddenly this watershed German spending moment, and then you have the potential for U.S. growth slowing and potentially tariffs putting up the walls to Europe. You put that together. Good luck, Christine Lagarde.
I need to be across a number of things as well this morning, not just in Europe. So over in Europe, the German debt market yesterday, biggest sell-off we've seen going back to the 1990s, a move of 30 basis points on a 10-year maturity. This morning, up another 6. Here stateside, we've got equities near session lows, down by 1.4%, just about on the S&P 500. Yields dropping at the front end of the curve on 2s, as we anticipate jobless claims data that drops in about 10 minutes' time before payrolls tomorrow morning.
Yeah, right now what we're seeing is exactly the script being flipped on its head, where suddenly growth looks potentially stronger in the Euro region and the potential for spending. Those jobless claims and those planned job cuts from Challenger really did shift the conversation just slightly. And now you see an increasing number of Federal Reserve rate cuts being priced into the market.
To extend the conversation, Pooja Kumra of TD Bank joins us now for more. Pooja, welcome to the programme. Let's start with Europe. Where does this effort from Germany leave the European Central Bank and Christine Lagarde in 20 minutes' time?
Good luck to Christine Lagarde, as you said in the conference. I think it's a very tricky situation. I think one thing which they were not expecting was such a big fiscal package. And how it gets implemented is still a big question mark, right? We have this envelope that's been given that will be spread out over 10 years. So we really don't know how much of it can actually get into the growth in the short term. Like, just to give you some perspective, we had an 800 billion NGU program that actually gave 1% growth in the 10 years. So I'm not sure how much it impacts the growth narrative for ECB right now. And even when it comes to inflation, it's hard to actually pencil down when we also know there's a risk of tariff. But I think for me right now, it's key is how do they think about restrictive? I think if they really seem a bit more complacent that they do not need to cut more rates, I think that's where you could see bonds getting really hit right now. And not just bonds, as we can see in today's session, the entire EGB complex is getting hit right now. Next, I will also be looking at how they are viewing the fiscal package. In case you missed, we did see S&P actually considering this fiscal package actually positive for German growth and its credit rating. I think in theory, it's a great concept, but what markets were not prepared for is like within a scale of 2 days, we've got easing from both EU and Germany, and which is really hard for markets to take in, especially in the world when ECB is not buying any bonds.
Pooja, I'm just curious, the comment from the ECB that they're not pre-committing to any particular path and that, frankly, they think that there has been a meaningful shift toward being less restrictive for policy. What kind of color are you looking for in the press conference soon?
So I think since ECB has actually released their paper on what they think about neutral, which is a range of 1.75 to 2.25, there's a lot of actually arguments, even within the market, as well as there is a lot of views across the General Council board as to what does ECB define neutral as. So I think here I would like to know what are they thinking. Do they really believe the statistic papers that said 1.75 to 2.25 is the range? And what I would be also looking at, okay, as a long term, given the fact that say in the period of 5 years, we do have this spending coming in Europe, and then how do we define this new neutral? So I think that would be key right now, and I don't think ECB is in the shape to actually answer this question, just given the fact that nothing seems to be certain right now.
Well, looking through the statement, it talks about lower exports, ongoing weakness and investment, in part originating from high trade policy uncertainty, as well as broader policy uncertainties. What's going on in the United States, even though we haven't seen these tariffs yet, is that already impacting on the ground what's happening in Europe in terms of trade and exports?
So far, the PMIs in Europe in Jan actually saw a pickup just because everyone was front-loading the entire tariff impact. But right now, general sentiment is we really don't know whether it's coming or not. April 1st is when we will get to know what is the consequences of all the retaliatory tariff that Trump is proposing. And if that goes through, it's a pretty big hit for European economy. If you look at VAT as well as the normal getting the tariff deal done, it could actually hit Germany close to 20%. So that's a very big move. But the idea, I think, with all central banks is we really don't know whether these tariffs are coming or they are just a negotiation tool. And I think that's what ECB will try to say, that they really have no clarity when it comes to tariffs. They know they are coming. I mean, it's very evident that Trump is actually coming to Europe. It is whether you think about the Ukraine war, whether you think about the NATO spending for defense, and next will be the tariff part. But actually, ECB as a whole needs to be on a wait and watch mode till April 1st.
Pooja, appreciate your view. Pooja Kumra there of TD Bank on the ECB after reducing interest rates by 25 basis points, and no one's going to talk about that rate cut. No one's going to be talking about that rate cut. They're interested in two opposing forces right now, which is fiscal stimulus potentially coming out of Germany. And I stress potentially because it's not done until it really is done and the money's hit the ground and we're actually doing things off the back of it. But at the same time, in about a month from now, could have additional tariffs on the European Union. And the ECB has got to somehow work out how to set policy somewhere in between.
So that's the reason why everyone's just looking at this statement that monetary policy is becoming meaningfully less restrictive and saying, what do you mean by that? And how much does this mean? And are you not going to cut rates again?
The news conference 20 minutes away. Look out for that. In just a moment, we'll talk jobless claims, more economic data just around the corner. Constance Hunter of the Economist Group, David Rogal of BlackRock, here to react. Jobless claims just seconds away. Equity futures here, session lows. Session lows and down by 1.3% on the S&P. It's been so volatile all week. On the Nasdaq 100, we're down by 1.7% in the bond market. Just a drop at the front end of the yield curve. Worth noting this morning, two-year yields declining by 6 basis points, so back below 4% at 394. We're down a single basis point on 10s at 426.50. With the jobless claims data and more, let's cross over to Mike McKee. Morning, Mike.
Good morning, John. Well, no major change in headline jobless claims, 221,000. That's a drop from 242,000 initially reported last week. We're redoing the numbers here, and let me just see. It's 242,000 unrevised. So not a major change now. Of course, the number that everybody wants to see is former federal civilian employees, 1,634 last week. So that's about triple what we had originally seen. They're starting to show up in the numbers now. And of course, that's only a 1,000. We have 20, 30, 40,000, who knows exactly, who have been laid off. Other big number today is the trade balance, negative 131,000 or $31 billion. That is up and probably close to a record. I'll have to check. But remember, we had that big increase in exports in the goods category last week. And this adds back in some surplus on the services side. And so it does narrow it a little bit, but that was the reason we saw that big drop in the Atlanta Fed GDP. Now we'll see how this impacts that.
Mike, noteworthy also, just Canada specifically, the Canadian trade surplus with the United States widening to a record. Mike, how much front loading are we seeing in this economy ahead of these tariffs?
Well, it'd be interesting to look at the actual data on Canada, because that stuff goes on all the time. But it is perhaps possible that a lot of auto dealers brought in cars from Canada to get ahead. Front loading is a major story in terms of the imports into this country in the last month's trade numbers.
Mike McKee, thank you, sir. Appreciate the update. Mike's going to be back with us a little bit later on Bloomberg TV, no doubt, to go through all of this and look ahead to payrolls as well. So jobless claims come in at 221. The estimate was 233. Previous number was 242. So no drama there. That's good news. The trade front just looks like a front loading of imports to certain places. Canada and the trade surplus with the United States widening to a record. Importing from America has been huge over the past month.
Yeah, and this, to me, the fact that the trade deficit just plunged over this period of time to the lowest going back in history. Frankly, it was the most going back to 2015, if you take a look at the trade deficit and how much it actually deepened in the United States. So to the front-loading point, how much are we seeing companies saying, okay, China, okay, Europe, let's get all that stuff in right now.
Canada, Mexico.
Yeah, Canada, Mexico.
The list goes on.
Yeah, you can't do that with avocados, though.
Joining us now, Constance Hunter of the Economist Group. You're very worried about that, aren't you?
I am.
Constance joins us now for more. Constance, welcome to the programme. Let's talk about the jobs data first. So no drama in jobless claims. That's good news. Are you expecting any drama in the payrolls report tomorrow morning?
I mean, we're expecting a softer payroll report than we've seen on the 3 and 6 month average. So I would say about 180,000. What we're going to be looking for, though, is under the hood what's happening, right? So it's not just government employees, but that services employees and consultants. That's where you've seen a lot of layoffs, right? So there's a multiplier effect from what's happening. And so there are a lot of people on the job market with very highly qualified skills. If we continue to have a fairly strong labor market and strong economy, I think those people will get sort of hoovered up into other jobs. But if we don't, then you're looking at some more longer term damage to the U.S. economy.
Constance, we were talking earlier this morning about this being really a big economy that takes time to really damage, and that some of the sentiment shift has happened a lot quicker than the actual underlying data. Would you agree with that?
Yes, absolutely. I mean, one of the things that we look at to think about forecasting payrolls is the ISM Services Employment Indicator, and that is still ticking up. Even though that's really a real-time indicator. But another thing that we look at that's really valuable is an uncertainty index that combines three things. So it combines uncertainty gleaned from actually EIU documents on our own website, or behind our paywall. It looks at changes in the tax code. So, of course, we have the TCJA up for possible extension. And then it looks for differential between economists' forecasts. And when we look at that index, when it has spiked up, it has presaged a recession is coming. And we are at levels that are well above the 2008 financial crisis, well above what happened during the dot-com bubble, and well above what happened in the 1990 S&L crisis. We're not quite at COVID levels, but we're pretty elevated. And so what we're doing is we're using that to forecast how is this going to impact CapEx, how is this going to impact household consumption.
How reliable has that kind of sentiment data, though, been, Constance, at a time? And I know that there are other things that go into this, but right now some people are pointing to the sentiment and talking about how negative it is. Annmarie's been talking about the Beige Book all morning, and she's right. And the word uncertainty or some variation of that came 47 times in addition to the 49 times of tariffs. I'm just wondering, we're not seeing the shift, though, in consumer spending habits just yet. I mean, people are worried about it, but we're not seeing it. So is there a chance that what people say and feel and what they do just isn't going to cohere like we've seen in previous cycles?
So are humans going to keep being humans? Yes. we have a lot of dichotomy, right, in between what we say and what we do. So yes, that's a significant possibility. And I think we also have to think about some of that front loading is happening in terms of consumer behavior as well, right? People buying things. If they were planning to buy a car this year, maybe they're saying, well, maybe I should buy it now rather than wait until April or May when perhaps it will be more expensive. With that said, though, rarely have you seen this level of heightened uncertainty without seeing it cause some pullback, both in capital expenditure and consumer behavior. I would say one thing underpinning this that we have not necessarily had in previous cycles, right, is we really are in the midst of an incredible productivity boom. And that could give us a bit more cushion than we would normally have. And then the other thing is that the Fed knows that it can afford to wait should things get wobbly because we have such an immense amount of mortgage equity in homes. And so you saw yesterday, all it took was the slightest move down and you had a huge increase in applications for new homes and applications for refinancing. So there's a lot of capital there on the sidelines to be deployed in the economy should we get into a weaker situation and should the Fed need to lower rates.
Constance, what kind of impact are you seeing Doge have on the labor market?
I mean, right now, I would say it's negligible, right? Like we didn't see it show up in claims. It's a large economy. So yes, these federal workers are getting laid off, but they're really highly qualified individuals, generally speaking, right? With advanced degrees and important specializations. So if they're not rehired by government, once people realize that they were actually doing valuable jobs, then it's very likely that they'll get rehired within the economy. And then, of course, some people chose this opportunity to take an early retirement.
Constance Hanser there of the Economist Group. Constance, thank you for joining us to break down the latest on the labour market. Jobless claims out just 8 minutes ago. No drama there at all. David Rogal of BlackRock joins us now for more. David, welcome to the programme, sir. Good morning.
Thanks for having me.
Let's take the temperature of markets together. Equities, a 5% pullback, high yield spreads. If I knew nothing about the world right now and I was on vacation, I'd love to be, and I'd missed the last 2 months and knew nothing about the headlines, trade, nothing, and you just sent me a chart of high yield spreads, I'd have no idea what was going on. Still south of 300 basis points, no growth scare here whatsoever. Anything to be concerned about?
I think we're seeing, so thanks again for having me. We've been pretty constructive on the economy. Again, taking a step back, big services economy, hard to break. I think you spoke about this before. And so what I think you're seeing really here is we had a huge amount of optimism in Q4. We actually had a huge amount of consumption, big growth numbers in Q4. And I think we're coming off that optimism on dereg, on some of the business-friendly policies, and more thinking about some of the near-term growth impacts. So I think what we're just seeing here is a moderation in growth expectations, and we'll see what happens from here. But I don't view it as a long-term serious negative.
Is this market pricing in a moderation or something more significant than that?
I think we're somewhere in between today. I think the concern really is that it turns into a recession, particularly if you look at the three things I think the market's worried about. It's immigration policy, that could be a negative supply shock. Tariffs, obviously, a hit to growth. And then some of the austerity through some of the spending cuts. But I think there's a big open question, uncertainty, in how big some of this is. And ultimately, our view is that it's a moderation in growth, but it's not a recession.
This all would have been palatable if we hadn't had a sea change over in Europe. It would have made a lot more sense and maybe a little bit easier to digest the fire hose that we've been talking about of different headlines. But now you add on top of it the fact that there is an alternative to the United States. And the U.S. exceptionalism isn't necessarily being countered. That's debatable. But certainly there are other places where we could see growth and fiscal investment. Does that change your view?
I think it's an important change. I think one of the impacts we've been tracking and one of the themes we're focused on is term premium. And I think with the idea of fiscal going up in Germany to the degree that you've seen, this supports our view on term premium. We think term premium is going to widen from here. And in our portfolios, we're focused on the front and intermediate part of the curve, less the long end of the curve. So I think this is another factor. I think term premium is a global concept. You saw for years with global QE, central bank balance sheets expanding to very large levels. That was causing cross-border inflows into the U.S., suppressing term premium globally. So I think that's another factor that's going to support the term premium trade.
David, typically, though, we talk about the U.S. exporting policy to the rest of the world. Are we importing policy from Germany, then, in the U.S. Treasury market in months and years to come?
I think it's going to be a meaningful factor. I mean, it remains to be seen how much gets spent and over what time period, but I think it will be a meaningful factor.
But who's pushing who? Isn't the U.S. actually pushing Germany, or is it now that basically reversing?
I think that the U.S. exceptionalism story has been driven by strong economy, strong domestic fiscal spend. I think you can see some of that reverse, but again, we're still constructive on the U.S. But I do think you could see some flows reverse on the back of this theme.
When you say term premium go up, basically you're saying long-term yields around the world are going to stay elevated and maybe go higher because there is a difficulty in digesting some of this bond issuance. How much does that constrain returns and risk assets? Because some of the money has to come from somewhere, right? I mean, so how much does that cause you to lower return expectations in other places or in the U.S. versus Europe to allow for all that money to go to finance some of these projects?
I think as long as it's a relatively orderly move in valuations, I don't anticipate seeing a huge amount of disruption. I think the potential is there if we were to get a disorderly move in term premium, but as long as the fiscal trajectory is supporting growth and it's supported for the overall global economy, I don't view it as a huge source of disruption.
Have we seen the bottom in long-term yields for developed market debt?
Well, I think listen. I think if I take it back to where fixed income is today, I think you could see some pullback from these valuations. But when we take a step back and we look at where yields are, we've had a 100 basis point decline in the funds rate. We've had a 100 basis point decline in money market yields, and we've had a rise in term rates. So I think you can now pick up around 100, 150 basis points by going into intermediate focused fixed income fund, particularly on the active side. I think that's an attractive investment opportunity. And I think they'll continue to support the market.
David, it's good to see you. Lots to think about. David Rogal there of BlackRock. Investment committees the world over need to reconvene and work out what's going on in Germany and what it means for fixed income worldwide. With an update on stories elsewhere this morning, here's your Bloomberg Brief with Danny Berger. Hey, Danny.
Hey, John. The White House said that it will exempt automakers from tariffs on Mexico and Canada for 1 month, following pleas from industry leaders. The exemption applies to auto parts that comply with the USMCA trade pact. It's intended to give companies time to come up with plans to move more investment and production to the U.S. Sources tell us that Klarna is looking to raise at least $1 billion in a U.S. IPO, set to file publicly as soon as next week. Klarna is targeting a more than $15 billion valuation in the New York Stock Exchange listing and plans to price the IPO in early April. Meanwhile, the New York Times reporting that FIFA will look into expanding the number of teams in the 2030 World Cup to 64. The expansion will reportedly be a one-off occurrence to highlight the World Cup's 100th anniversary. The next World Cup will be mostly played in the U.S., with some matches in Mexico and Canada in 2026. That's your Bloomberg Brief, John.
Danny, thank you. Why damage something so perfect? I have no idea. The World Cup, why do that? Such a great format. They did this to the Champions League. I don't get it. Up next on the programme, we'll set you up for the day ahead. I'm alone on that one, I know. Write in.
Yes. You're like, please
do.
write in to
send me an email, and I'd be on the Bloomberg terminal, whatever you want. Up next on the programme, a news conference with ECB President Christine Lagarde from New York. This is Bloomberg. The European Central Bank reducing interest rates by 25 basis points. The ECB news conference is underway. We'll cross over to that in Frankfurt, Germany in just a moment. This came from Deutsche Bank just moments ago. The ECB finds itself in a challenging position between the threat of US tariffs in the near term that could warrant further policy rate cuts and a move into stimulative territory, and the growing commitment to higher defence spending over the next several years, which will be required to secure Europe's strategic autonomy. That is the tricky position this ECB president finds herself in this afternoon in Frankfurt, Germany.
Is it a growth shock from tariffs, or is it a growth shock to the upside from potential fiscal spending? How does she navigate that question?
Let's cross over to the news conference right now with ECB President Christine Lagarde.